having Donald Trump come into office is a very welcome change, and we hope that we will let market forces drive.
Generally speaking, he's looking to stimulate investment in the United States and really foster more innovation, more growth.
A lot of the Americans at the moment are actually saying, I only want to be in the U.S.
Every marginal dollar around the world is looking at the U.S. as a significant opportunity.
A very strong U.S. economy is a good thing for the world and the world economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning from New York City for audiences worldwide. This is Bloomberg Surveillance. I'm joined by Danny Berger today. I'm Anne-Marie Hordern and also Michael Purves of Tallbacken. Joining us for the hour, John and Lisa are making their way back from Davos. I made my way back from Washington, D.C., where really all the policy uncertainty is emanating, but Donald Trump touching basically every part of global financial markets. Futures this morning are a little bit softer, but this, of course, comes after yesterday. S&P 500 hit a record high. First time U.S. stocks had its all-time high for the year. So first time we hit that record for 2025. Starting this morning, a little bit softer, taking a little bit a touch softer this morning on equity futures. This comes as Donald Trump seems to be taking a step back when it comes to tariffs and some of the tone he's striking. He seems to be in negotiating mode when it comes to tariffs, and persuasion mode when it comes to interest rates, jawboning the Federal Reserve and really global central banks that he wants lower interest rates. Danny, take your pick if you're an investor on what you wanted to hear out of the White House.
Oh, by the way, not just rates, but also oil too, telling Saudi and OPEC that he wants them and he will ask them to lower prices. Anne-Marie, if we had said 2 weeks ago, you would have had this sort of jawboning from Trump, and it would have been the first week of his presidency, we would have expected extreme volatility everywhere. We would have imagined that the bond market would have had a bigger reaction of him trying to jawbone the Fed. Instead, it's been calm. Yes, there's been some choppiness, but we've been trading in a range. I think Ian Lincoln of BMO really nailed this heading into this week, that markets saw the inauguration as an event risk, and we just needed to get past it. And once we get past it, we can kind of continue on this rally. And we did. We reached all-time highs, as you said.
And the dollar is lower. Around the world, currencies are taking, Michael, this breath of relief that he is really starting to tone down the rhetoric when it comes to tariffs.
Yeah, it's really interesting just to think that the Euro stocks is up a lot more year to date than the S&P 500, right? So I think there, certainly there's a lot of sort of classic Trump trades coming out of the election that worked for a little bit, and then they kind of U-turned and they're kind of back to, really stasis right now, or where they were just before. So yeah, I think it's going to be very interesting. One of the things that I'm really focused on is, so he was softer on China yesterday, but he's never going to go completely clear and resolute, right? Because then he loses his negotiating leverage.
He's in negotiating mode. And here's the quote. We have one very big power over China, and that's tariffs. And they don't want them. And I'd rather not have to use it. But it's a tremendous power over China. Right. So he's full on negotiating mode.
Right, but he cannot lose that power, right? So will we ever have absolute clarity as to where he's going to be with tariffs? He always has to keep something back. And as we all know, Trump can pivot very quickly. So I guess to my mind is, how does that uncertainty principle, if you will, in a world where the economy, the markets want clarity, CEOs want clarity, right? How does that uncertainty principle filter into things like bonds and things like equity?
But this is the irony of it, is that there is so much uncertainty. And how often do we say markets hate uncertainty? But the market is concentrating on this big business growth environment we're going to be getting, on the animal spirits coming up. That seems to be the concentration. And do we get this kind of roundabout thing where, because markets are lulled by the calm, it allows Trump to go harder on tariffs because markets are giving him the green light? They aren't sending yields higher and making him put the brakes on.
Absolutely. I think in these first few weeks of the Trump presidency, what I think we're going to be experiencing is Trump needs to test the boundaries of the markets. He can go here, he can go there, say this, that, but he needs to understand what the reaction function of the bond market is and the stock market is. The tricky thing is right now we've got a great, let's say, we still had Biden as president. There wasn't an election in November. It was just sort of more of what we had last year. Look, you're looking at a strong economy, looking at strong employment. You're looking at a pretty healthy consumer. You're looking at great, so far, really strong corporate earnings. So you have to take that away from the sort of the new animal spirits and dissect it. So, if those fundamentals change a lot, right? Just nothing to do with Trump policy. Just if they do get weaker, that's where we're going to have to see yet another way of where the reaction function is to the markets. It's a moving target constantly.
Well, as he's testing those markets, let's take a look at where they're trading this morning. This Friday morning, happy Friday. It's been a week. So we do have S&P 500 futures a touch softer. This, of course, though, as yesterday, U.S. stocks hit its first all-time high of the year. And global stocks are really liking, when it comes to Trump testing the markets, they're really liking this idea of potentially signaling at the moment that tariffs are being used as a negotiating tool. Of course, the euro dollar, 104. One at one point was 105. We did get some better PMIs out of Europe, but really this is a dollar weaker story because of that tariff story. 10-year yield. Basically, what's happening with the 10-year yield is nothing. The U.S. bond market ending the first week of Trump's second presidency pretty much where it began, 4.62%, let's say 4.63%. And crude, something Danny talked about at the top of the program, Donald Trump drawing down the crude market. Oil is set for first weekly drop this year. He's telling OPEC, put more barrels on the market. Coming up this program, Margie Patel of Allspring Global Investments with stocks at fresh all-time highs. Terry Haines of Pangaea Policy as Trump softens his tone on China tariffs. And Steve Englander of Standard Chartered as the BOJ hikes interest rates. We begin this hour, though, with stocks at record highs after President Trump said he would rather not impose tariffs on China. Margie Patel of Allspring Global Investments writing, quote, Trump administration has announced many changes to regulations and new initiatives. It is too early to judge their effects on the economy and financial markets, but we believe many will reinforce the areas of the economy which we have expected strong growth. And Margie joins us now. Thank you so much for joining us this morning. I would love to just get your reaction to the past 24 hours and what surprised you the most about what we've heard from 47th President Donald Trump and his second administration, seemingly touching every part of global financial markets?
Well, I think that's really coming out strong and stating a lot of his positions, and positions that, as you pointed out, maybe he doesn't expect to be achieved, but it's a good place to negotiate from. And I think the most important thing, frankly, is that the idea of higher taxes is totally off the board. That was a big risk to the market last year looking out into 2025. So I think that's the number one important thing is no increases in taxes and maybe even some lower taxes as well as lower regulation, which, of course, will be very positive for the markets.
Margie, you are describing a status quo of sorts, though, just an extension of the tax cuts. And Anne-Marie got to this when she was reading some of your thoughts. How do you disaggregate the strength that this market is pricing in and the continued strength of equities, just being a good business environment from a strong starting place versus actual policy? How dominant will politics actually be for risk assets?
Well, I hope not too strong. I hope that the changes that are made will, in fact, reinforce the areas of strong growth that we've seen. And I think this year is going to be another year of continuing trends where technology is very strong, data center investments is very strong, improving the electrical grid is very strong, and we'll see more investment in our domestic energy sector. So those were all in play last year, and I think they'll continue. And this will be another year of surprisingly good profits and a surprisingly good equity market.
There has been a shift, though, over the past month or so. Since about mid-December, Margie, what you've seen outperform, it's been energy, utilities, industrials, financials, cyclical parts of this market that are sensitive to growth. It is this extreme growth optimism that we're pricing in. Does that continue on, or do we have an event that makes us run back to the safety corners of the Mag 7?
Well, I don't think it's extreme optimism. I think when you look, basically, putting aside the politics and what we may get out of the new administration, is the U.S. economy is really in good shape. We're growing at a sustained level of, say 2.5%. And there are signs that growth may even be stronger, maybe closer to 3%. So that's really very, very positive, and that would allow the stock market to be up, say, 8, 10, 12% conservatively this year, maybe even higher. So I think the surprises might be continued growth and maybe even stronger than we're expecting. Maybe that's what the market is really telegraphing, is continuation and further strengthening, particularly when we see these other areas that have broadened out a little bit.
Margie, one question for you. We're dealing with a very high valuation on the S&P 500, and through a lot of the sub indices there, it's about sort of top 2% valuations here. Do you see at multiple compression as sort of something that's going to happen, or do you think the market will, the earnings will be so explosive this year that it will actually bring the multiple down to more normalized levels that way?
Well, I don't think the market is, an average doesn't tell you the whole story. If you look, you have a relatively small number of stocks that have very high growth, earnings growth of, say, 20%. Those are the ones that are trading at big premiums for PE. And then a lot of the market that's actually having very low growth has a relatively more modest PE. So when you put it together, it looks optically a little higher. But I think the market is fairly priced. And I think that a lot of the uncertainty that we have has really gone out. There's a more positive outlook. I do think, though, last year we had a lot of our total return in the Standard & Poor's, which was up 25%, was due to expansion of the price-earnings multiple. I think this year we'll probably see more companies whose earnings are high will get a higher stock price, and not that expansion in PE, just really look more dependent on the profit growth of companies.
Gotcha. So PEs are going to stay where they are, but are you bullish on the rotation away from big tech into the more cyclical parts right now?
Well, I think only those cyclical parts that are part of this more secular change in secular growth, which is, I think, the reshoring back to America is real and it's going to continue. I think the investment we need for data centers is a decade-long process, and also the electrical grid, which looked very stable for a long time, now suddenly looks as if we'll have growth in demand for power, and we need to strengthen the grid, expanding it. So that's a lot of additional revenue for the industrial sector, and technology is part of that. So we think those will continue. And then energy, domestic energy, it looks now as if there was sort of a cloud over that energy sector, I think is actually more positive. We may see more investment from the energy sector.
It's something Washington, D.C. is definitely focused on, whether it's AI data centers or just unleashing more when it comes to American energy. Margie, Patel, thank you so much for your time this morning, of course, of Allspring Global Investments. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Sonali Basak. Hey, Sonali.
Morning, Anne-Marie. The Bank of Japan raised its policy rate to 0.5%, the highest level in 17 years. The decision fueled expectations for future rate hikes and strengthened the yen. The central bank warned inflation will move at a faster pace in the coming years compared to its previous forecast. And shares of Burberry surging after a pickup in U.S. demand raised investor hopes for a luxury market recovery. Retail sales fell 4%, but the drop was less than expected, with analysts expecting 13%. Still, the label warned that the economic environment remains uncertain and that the transformation is in its early stages. And JP Morgan Chase CEO Jamie Dimon got a pay bump in 2024. Dimon earned $39 million in salary and performance-based compensation, up 8.3% compared to the year before. In the same year, JP Morgan beat its own record for the highest annual profit in the history of American banking. And that's your Bloomberg Brief, Anne-Marie.
Sonali, he's not the only one, right? 39 million seems to be the magic number this year.
You have David Solomon as well, but David Solomon and John Waldron got those $80 million incentive packages on top of that $39 million, Anne-Marie.
Ooh, all right. Banking's doing well. Up next in the program, a softer approach on tariffs.
We have one very big power over China, and that's tariffs. And they don't want them, and I'd rather not have to use it. But it's a tremendous power over China.
He'd rather not have to use them. That conversation coming up next. You're watching Bloomberg Surveillance. Good morning. Happy Friday. Markets this morning, futures are a little bit softer, but of course yesterday we had U.S. stocks hitting their first all-time high for the year for 2025 and really around the world, just taking a sigh of relief after comments from President Donald Trump basically saying that he wouldn't really want to use tariffs. He could, but he doesn't really want to do that. And that's where we begin our political discussion this morning. Under surveillance, a softer approach on tariffs.
We have one very big power over China, and that's tariffs. And they don't want them, and I'd rather not have to use it. But it's a tremendous power over China.
China's already paying a lot of tariffs because of me. And when you add them up, I would say, they're paying a lot. They've paid hundreds of billions of dollars. So they've already started at a higher base.
Here's the latest. President Trump revising his message on tariffs on China, saying he'd rather not have to use them. Trump previously, of course, threatening 10% tariffs as soon as February 1st. Terry Haines of Pangaea Policy writing, tariffs will happen for three reasons: economic unfairness to the United States, not producing products in the U.S., and or to help achieve U.S. geopolitical goals. Terry joins us now. So, Terry, is Tariff Man just in full-on negotiating man mode?
Good morning. I think my advice to Marcus has always been, look, this is never going to be all of one thing or all of the other. And the approach is going to vary by country and product for the three reasons that you've kindly put on the screen. So basically what Trump would like to do with regards to China might be very different than what he wants to do with, say, Canada or Mexico. With China, what this is about an outstretched hand saying, look, you deal with your proxies, you deal with Iran, you deal with Russia, you deal with the Mexican cartels coming across. We can reach deals and accommodations here. But if we don't do that, then, I've got some powers and some abilities to ramp up pain on you. So, this isn't an all one or all the other decision.
So help market participants, though, that are watching this and a little bit confused. The executive order talked about a review for April 1st, but then Trump talked about potentially enacting tariffs February 1st, which is next week. So how do you view the timeline of potentially what is going to be his tariff policy?
I'd encourage markets to look at both dates instead of just one. I think the question probably revolves around, tweaking existing tariffs, making sure that China understands sincerity of intent, with the idea that in a couple of months, what might happen is something larger and more systemic.
Terry, though, just the facts of this first week have just been so much more carrot than stick for China. I mean, we could go through all of them, giving TikTok a reprieve, saying it doesn't pose a national security threat, inviting a high-level Chinese official to the inauguration, threatening 10% tariffs instead of 60%. Why soften? What is the aim? Why go after this approach instead of doing the hardball negotiation that Trump said that he would do on day one?
I don't think it's been all carrot or all stick. I think it's been some of both. You can look at the Stargate AI announcement as a perfect example of that. Something that said to China, among other things, look, game on AI. I'm going to go big and I'm going to go hard, and I'm going to attract a ton of investment into America by doing that. Whether it be and beyond Stargate, you even have the proposed Saudi investment. So I think there's a lot of sticks going on here as well, but the sticks are much more deeds rather than words.
Just on that investment, Terry, as you mentioned, both Saudi committing an investment or vocally saying so, as well as this AI Stargate venture. We saw in the first iteration of Trump similar announcements. However, the follow through didn't always come to fruition. And you had kind of some of these players learning that you could make announcements to placate Trump without going all the way through. Does that change in this iteration of Trump? Do you see a Trump administration that wants to enforce some of these spending commitments more forcefully?
I see an administration and a president that understands that he's got exactly 4 years and no more, and he wants to maximize his impact. So there's much greater focus this time out.
Are you reading the tea leaves here within the White House that Bessent is really emerging as a very strong and clear voice, and the more overt trade hawks are losing some position right now? And is this something that the markets can take comfort in, or is it going to be sort of an unstable condition?
Hi, Mike. Good morning. Couple of things. One, Anne-Marie always very kindly brings up that I came up early with this team of rivals concept when Bessent and Lutnick and others were brought in. I look at tariffs again as very much a country-specific, issue-specific, product-specific sort of thing, and I would not look at the early returns here as a sign of Bessent winning or losing. I think it very much depends on all of those things.
Gotcha. Okay.
Well, he hasn't even stepped foot in the door yet when it comes to Scott Bessent, right, Terry? He still needs to be confirmed. Potentially it's going to happen this weekend. Howard Lutnick over at Commerce has a hearing that he still needs to go through. So in that sense, is that also what's pulling Trump back from enacting these day one broad-based tariffs? He actually needs his team in place, and at the moment, they aren't.
Yeah, I think there's a little bit of that. At the same time, nominees can always advise informally, and I don't mean under the table in some secret way. I just mean that, they can advise on where they think things should go without having the power to actually do anything about it or have any levers in their hands, because of course they're not confirmed, as you point out. But it is a little bit of a in development sort of thing when it comes to Trump's advisors generally. And that may be playing a little bit of a role here. But I do think that with regards to China, the main thing here is that, Trump's putting out that he'd much rather negotiate out a lot of the large issues, geopolitical issues. And if China's willing to do that, he's willing to play. But at the same time, his patience is not going to be inexhaustible.
I want to also pivot to what's going on regards to the Fed. I'm sure Jay Powell was happy that the Fed is in a blackout period ahead of their meeting next week, because not only did President Trump go to Davos and say he wants lower interest rates and he thinks lower oil will be the means to that end, he then told reporters, "I think I know it certainly much better than the one who's primarily in charge of making that decision. If I disagree, I will let it be known." Terry, is it too early for him to be jawboning the Fed? Is there a concern about Fed independence?
Well, it's too early, not for the President Trump, certainly. But Fed independence, I think, is not an issue here, and is not going to be an issue. And the fundamental reason why is that the Fed gets to make its decisions independently, so that's Fed independence. But the Fed is not a creature of the president. The Fed's power doesn't derive from the president; it derives from Congress, and so the president really doesn't have any ability to meddle in any of those things. Now, I'm well aware of sometimes in the past, whether it be President Truman or President Nixon, where that's in fact happened. I really don't think it's going to happen here. What's going to happen is that should Trump try to cross that line, Congress is going to slap back at him pretty hard, and Congress has shown the ability to resist Trump's blandishments on all kinds of things, including the pace of nominees so far, right? He wanted nominees in 2 months ago, and they should go immediately. And, we've just talked about many nominees that haven't even gotten confirmations yet.
Just to stick on the point of the Fed, Terry, perhaps it's not an issue for now, but should we look at this as a view into what happens when Chair Powell's tenure is up? That someone like a Chris Waller comes in, or someone is put in place that will be cutting rates, that will be more amenable to the jawboning coming from Donald Trump?
Well, I'd put it this way, Danny. The markets have proven to, I think, to me anyway, and the economists who buzz around the Fed, pretending to be experts on it, buzz around and say, oh yeah, there's going to be a big threat here when that happens. At the same time, I'd point out that Jay Powell very much disappointed the Biden administration. When he got reconfirmed, they thought they were getting a dove, and they thought they were getting more free money. Instead, what they got was Powell and the entire Fed becoming hawkish almost immediately and embarking on the policy path where we are now. So I would look for Governor Waller or whoever else ends up being there, continuing to exercise independence.
Terry, thank you so much for your time this morning. Terry Haines of Pangaea Policy. But of course, Danny, they had to embark on that because inflation was so high.
Exactly. And I have to say, sometimes the Fed is almost, this is a bit controversial, but a bit like a child. You tell them not to do something and they're going to do it. So you tell them, I'm coming for your independence. They might push back even harder.
Child or punching bag?
Yeah.
We'll have to see. Coming up on the program, Trump also urging OPEC Plus to lower oil prices. You're watching Bloomberg Surveillance. Good morning and happy Friday. Of course, this was the first full week, working week for the newly elected president, and he is touching global markets around the world, whether or not it's from equities to currencies to the oil market. This morning, we do have global stocks, a little bit of a relief rally when it comes to global stocks. They are ending the week at record highs. We did have a record high yesterday in the U.S., but Danny, this morning, a bit softer when it comes to the futures.
A bit softer. Maybe there's something in this that the action this week has been an administration giving tariff policy that's not as bad as feared. But that being said, there's still enough unknowns in this market that entire interpretation of it could be rattled. Anne-Marie, you made this point. It's not April 1st that Trump has been talking about bringing tariffs onto trading partners. It's February 1st. That comes in a matter of weeks. We continue to have these event risks pop up with every time Trump kind of changes the goalposts or the timelines of what he wants to get done.
Right. It's next week. So they also need to get their personnel in place in order to potentially enact some of these policy changes. When it comes to the bond market, really no drama, as Jonathan would say, as him and Lisa make their way back from Davos, Switzerland. The 10-year yield, 4.63%, exactly where we started on Monday when Trump was inaugurated.
And that's also after Trump said the Fed needs to be cutting rates. I will demand they do so. Oil needs to be lower. The irony is you had a little bit of movement on the front end that came in. It was actually long end bonds where yields pushed higher. The exact opposite effect of what Trump would have wanted. It just goes to show, Anne-Marie, his jawboning cannot overcome the bond market vigilantes.
And when it comes to tariffs, the place that we saw the whipsaw back and forth over the course of the past week and really months, depending on what reports you were reading, is the currency market. Weaker dollar. Now, that's obviously playing out in the euro dollar, but also a weaker dollar when it comes to the yen. But that's also for a different reason.
Yeah, the Bank of Japan, and by the way, not that different of a reason, because they hiked this morning because U.S. politics allowed them to do so. This is so important for the Bank of Japan. The reporting was you had U.S. data in their hand, and that was calm enough. It wasn't a big surprise. Therefore, they could hike as long as we didn't get anything that was really volatile coming from the Trump administration. They wanted to wait until the inauguration to make this decision. It happened. But there are still fragilities there that might stop the BOJ on its tracks, much for the same reason that we could see fragility in this overall market, depending on what happens from U.S. policy.
Right, policy moving markets this morning. That's where we're going to start for Under Surveillance. President Trump telling Fox News he'd prefer not to have to impose tariffs on China, still calling them a, quote, tremendous power over the country. This coming after he did threaten on his second day in office to put 10% tariffs on China as soon as February 1st. Peter Cheer of Academy Securities pointed out to this. It seems obvious to everyone now that this has become a negotiating ploy. He talks about it to rally his supporters, but is listening to those who caution about being too aggressive or too preemptive. Michael, is that what you think the market is? They're seeing this as a negotiating tool?
Certainly, yeah. They're looking at this as a pretty good setup right now. That any sort of real downside from the Trump campaign promises is really not going to materialize, and this is all, the art of the deal, and so forth. And so far, I think that's a pretty credible thing. And of course, there's a lot of good things that are coming out of the Trump agenda too, in terms of, the deregulatory push and so forth. So right now, I think things are really set up pretty well. I guess my question for risk assets like equities is, we're trading at 22.5 times earnings. Earnings are so far looking, pretty good. The economy's in, real pretty good shape, but can we really sustain? Are we vulnerable to PE compression, particularly if the bond market does start selling off again, right? And I think that's going to be really, one of the big questions is, Trump might, demand interest rates lower, but he's not going to control the back end of the curve. And I think that's really where so much of this discussion is really going to go. It's, to my mind, is where's the Trump bond market put struck? And that's a discovery process that is inherently a volatile process, right? And I think that's sort of looming here. And when you're at more than 22 times earnings on the S&P 500, that just makes everything a little bit more fragile here. So, I think it's going to be an interesting winter. I think some of this, everything is good, nothing is really bad from the Trump agenda it's a little bit priced to perfection. And let's face it, what's been lifting the market up is really animal spirits right now, right?
Yeah, when everything is so good, does it mean we're more fragile? And I think that's what you're getting at, is that we are fragile to headlines, that things aren't bad. But coming back to Trump and tariffs, if it's a negotiating tactic, you have to be willing to proverbially shoot the hostage, right? You have to be willing to take the big steps and do that. And if it's an equity market that's not prepared for that, how bad does it look if he actually does impose something like 60% tariffs on China?
Yeah, exactly. And just to build on that, this is not like, okay, you're just, Trump, a real estate guy, buying a building, and once you own the building, you own it, right? This is an ongoing dialogue, ongoing relationship. I don't know what percent of consumer products in Walmart are made in China, right? But it's something where there's, I call it Walmart inflationary risk, right? Where if the consumer goes into a store and has to pay a lot more for something that was made in China, whether it's their kid's bicycle or whatnot, it really is sort of a big thing. So there's this ongoing dance, but it's a dance filled with friction and tension. And what I don't know yet, and I don't know if anyone knows yet, is how does that frictional component of the Trump art of the deal gets priced into markets, whether it's the VIX, whether it's equities, whether it's the back end of the Treasury curve.
President Trump is also questioning Fed Chair Jay Powell's decision-making on interest rates and saying he'll speak with him about lowering rates at, quote, the right time.
I think I know interest rates much better than they do. And I think I know it certainly much better than the one who's primarily in charge of making that decision. But no, I'm guided by them very much. But if I disagree, I will let it be known.
Oh, shocking. If he disagrees, he's going to let the world know. You have to think Jay Powell is so excited that they're in a blackout period.
Oh, absolutely. Yeah. And I'm sure he will get questions about this. And maybe we get another, one-word answer. Nope, not permissible under the law. But this is the thing. And, Michael, we were talking about this in the break, that Powell, let's imagine a scenario where Powell listens to Trump and he says, Mr. President, you're right. He comes out and says, we are cutting. We heard you loud and clear. Interest rates are moving lower. You could still have a scenario where, in fact, policy gets tighter because the bond market does what it has been doing. And that is sending long end yields up higher. Yeah. Perhaps he learns the lesson of the Clinton administration when it is the bond vigilantes that set policy and the government and the Fed only have so much control.
Look, when the Fed started its cutting cycle in September with the 50 basis points, they were cutting. It was the first time the Fed had started cutting in with high yield spreads at the extraordinarily low levels that they were when financial conditions were as easy as they were. They were making history. They were cutting into low fours unemployment, right? And GDP that was around, trending towards 3% here. So now you're asking effectively, the Fed and the markets to sort of embrace this. Okay, we're going to run hot fiscal, and let's run that concurrently with a hot monetary regime. I mean, that's a recipe for all sorts of inflationary risk down the road, and maybe not that far down the road, right? So if inflation, if Trump was elected to make inflation lower again, well, that may be a recipe to actually make it higher again, or at least to be perceived by the bond market. And if if what's going to happen to Trump's approval ratings if mortgage rates go from 7% up to 7.5% to 8%, because some of those things start playing out.
Right. This is going to be important to watch. And I do think inflation for them is going to be one of their North Stars in terms of something they're very sensitive of. Right. And in corporate news, Boeing delivering disappointing fourth quarter results, posting revenue that missed estimates, saying last year's strike affected their results. The plane maker also noting $1.7 billion in charges tied to programs in its defense business, and that stock is down more than 1% in pre-market. All right, now back to policy. President Trump vowing to push Saudi Arabia and other OPEC nations to lower the cost of oil. Nadia Wiggen of Svelland Capital saying this, quote, Trump would like to drive a wedge between Saudi Arabia and Russia, pushing the Saudis to increase production at the expense of Russia. Sell-side analysts seem to assume any boost in production from the Saudis would be very temporary, a few months, but what we see from OPEC is that they prefer to move slowly. Nadia joins us now. Thank you so much for joining us this morning. So when Trump comes out and makes these pronouncements, do you have an idea of what price he has in mind?
Yeah. First of all, he just wants the price lower. When we look at a historical level in terms of real prices, we're not even at such a high oil price. Even at $80, at $70, what it used to be. He wants gasoline prices lower for the consumer, and he wants oil prices just to be lower, at least than what the Biden administration had. On the flip side, he wants producers to keep producing, and especially American ones. And that's where we see him in a tough situation because U.S. production is not growing the way it has. There have been enormous efficiency gains, but still, results came out lower for the end of last year in terms of U.S. production than we had at Svelland Capital in our expectations. So at the margin, producers are not ramping up. Exxon is not ramping up the way they could, the Pioneer Resources, if there's 1 billion barrels of additional oil there. It's not coming.
Well, this is the thing, Nadia. What incentive could they possibly have? Because domestic producers are beholden to their shareholders. If they start putting out more energy into this market, prices will go down, and that's bad for Wall Street. To what degree does Wall Street just dictate this, and Trump really can't have that much of an impact?
This is when we look at the potential U.S. supply growth this year, we have it up to 400,000 barrels per day. Some forecasters have as little as 200,000 barrels per day year-on-year growth. If we have oil prices that are higher, say, above $90, which is very tricky for the Trump administration, then maybe we get another 150,000 barrels per day. But compared to the sanctions we're talking about and the 2.5 million barrels per day of spare capacity that OPEC can bring online, that is nothing. So it's really why he is correct in saying that he wants OPEC to produce more.
Nadia, it's Michael Purves here. Just to react to Danny's point on protecting shareholder value, is there, with Trump comes less regulation and presumably some significant lower operating costs for U.S. producers. How much do you expect that to happen in a per barrel level? If the marginal cost if oil's going to stay at 60, is it going to become 52 as that new sort of swing point as to where a producer might increase or not decrease production?
What we have to remember is, we hit record U.S. production under the Biden administration. So he hasn't been holding back the oil side. The biggest difference is about natural gas and flaring and things like that. That has been an additional cost. So that's where we see this small improvement coming forward. Now, according to the producers, their break-evens, they're fine at $60, $65 a barrel. Maybe it brings down the break-evens for some producers a little bit. And this is where, when you have support from natural gas prices, from Henry Hub, it means that you can have more support for the oil break-even because that associated gas in the shale patch actually makes money. If you add in the fact that, okay, maybe in some places you can actually flare under Trump 1.0, nothing was enforced in terms of, or minimal enforcement was happening on the flaring side. That can help at the margin. But when we're talking about the big numbers, it's not really there. As we saw yesterday in his Davos address, we had the CEO of Total, asking about LNG and nat gas, not about oil.
Right, because the Europeans are also excited potentially maybe make a deal. They came out after Trump was elected, Ursula von der Leyen saying we can maybe buy some more LNG from the United States. I just want to end on potential supply constraints from places like Venezuela and Iran. What do you think the policy is going to be?
So far, Trump looks like he's going to be quite tough on Venezuela. That seems coming from Rubio. On Iran, he has managed to enforce sanctions in the past, but I think he wants the Saudis to play ball and make up for that. What we have to remember, in 2018, when he sanctioned Iran, he then granted 6 months worth of waivers for a lot of countries, including Japan, that hadn't touched Iran. And what we saw is Q4 versus Q2 production jumped 2.5 million barrels per day from OPEC, including Saudi Arabia, Russia, and the US, those three across the board. And then we had a price collapse. And the Saudis are really going to be hesitant about bringing back oil in that kind of situation. So they want to see what is happening. And this is where we think that the Saudis will think long term. And so that's the question, because Saudi Arabia and Russia are very close at OPEC now, but maybe they would like to displace Russia as a top 3 oil producer and take that away and into the rest of OPEC. But right now we have no signs of that happening.
Nadia, thank you so much for your time. Nadia Martin-Wiggen of Svelland Capital. Let's get you an update on other stories we're watching this morning. Here's your Bloomberg Brief with Shonali Bassick. Hey, Shonali.
A federal judge temporarily blocked President Trump's executive order restricting automatic U.S. citizenship at birth for children of immigrants who entered illegally or have temporary legal status. The judge called the order blatantly unconstitutional. The administration is facing at least 6 lawsuits over the birthright citizenship order. Apple and Google removed TikTok from their app stores since the app briefly went offline over the weekend. The move comes despite President Trump's pledge not to enforce a national security law that would punish U.S. partners of TikTok. Oracle has kept the app operational, raising concerns that the cloud company might have opened itself up to lawsuits and fines if the administration decides to retroactively enforce penalties. And President Trump signed an executive order to create a working group to advise on crypto policy. The order supports regulated dollar-backed stablecoins and seeks to prohibit central bank digital currencies. The group will submit a report to the president within 6 months to recommend a regulatory framework and legislative proposals, including potentially creating a crypto stockpile. That's your Bloomberg Brief, Anne-Marie.
Thanks so much, Sonali. Actually, it was the crypto ball this time last week that everyone in Washington, D.C. during the inauguration
Snoop Dogg was at it, right?
Snoop Dogg was there, and apparently everyone said it's the best ball.
I mean, I'm sorry, I don't care what it is. If Snoop Dogg's there, it's the best. It's the best ball.
A lot of people are very excited about that. All right, up next in the program, tariff worries.
Dollar yen is probably more a function of what's going on in the US than it is in Japan, really. So the question is, if people think Trump is going to be aggressive on tariffs, if people think that inflation is going to be high in the US, if people think that the Fed is going to be tough, then probably the dollar is going to stay strong against the yen.
That conversation coming up next. You're watching Bloomberg Surveillance. Markets around the world breathing a little bit of sigh of relief as President Donald Trump signaling his plan for tariffs. Right at the moment, tariff worries potentially not as big as they were before he came into office.
Japan is a lot more comfortable with the state of economic growth and concerned about inflation. The trend will definitely continue in terms of higher Japanese rates. Dollar yen is probably more a function of what's going on in the US than it is in Japan, really. So the question is, if people think Trump is going to be aggressive on tariffs, if people think that inflation is going to be high in the US, if people think that the Fed is going to be tough, then probably the dollar is going to stay strong against the yen.
Here's the latest. Investors expecting further rate hikes and yen support from the BOJ after the central bank lifted its policy rate to the highest level since 2008 and raised inflation projections. The BOJ saying uncertainty around President Trump's tariff policies will weigh on foreign exchange. Steve Englander of StanChart joins us now. Steve, thank you so much for joining us. So this was pretty much baked in, but really depending on where U.S. policy goes, is that going to be the deciding factor for this BOJ?
Well, if you read and watch what the BOJ is saying, yesterday they lifted up their inflation forecast, talked about upside risk. I actually think that a lot of this is driven by what's happening in Japan. The timing, I think, is dictated by concerns over, is it going to be, full Trump or mini Trump in terms of the policy actions that he's taking and the disruption that he causes. But I think the big surprise yesterday, because a lot of people came into the meeting thinking that BOJ was going to hike and then say, we can afford to wait. They seem to have much more intensity about further hikes. We think that they'll hike twice more this year, going up to 1%.
And yet, it's a yen that's reaction has kind of disappeared from this market, Steve. Your interpretation seems to be one of a more hawkish UEDA and BOJ than perhaps this market was expecting. Are you surprised we're not seeing more strength at this moment from the yen?
Yeah, I'm actually doubly surprised because, it's not responding, obviously, to the sort of rate differential story in at the short end. And in addition, in the past, it's actually been pretty well correlated with CNH. And the fact that the CNH has strengthened a lot and yen hasn't done much this week, I think remains a surprise. But I think if the market begins to think that the BOJ is serious about hiking, we'll see those rate differentials close. I mean, the rates gap between the UK and Switzerland is actually quite much wider than between the US and Japan. So I think that that story over time, I think, will evolve.
Steve, maybe we can add triply surprise to this, because this is the week of Trump's inauguration. Most asset classes have been trading in a range. The place that we've seen the most volatility has come from this currency market, whether it be dollar MEX, whether it be the Canadian loonie. That's where we've seen the action, even strength coming from the euro. What do you make of the fact that it's been FX this week, the asset class that's seen the most reactiveness to the things coming from the Trump administration?
Well, the way I see it, and if you look at what happened, say from the beginning of October when Trump presidential odds started going up till, say the middle of last week, dollar strengthened way ahead, way beyond what interest rate differentials were telling you it should strengthen. And we think a lot of that was risk premium. Markets were going into the inauguration thinking 60% tariffs on China, whatever, 10% to 25% on the U.S.'s friends in the world. And a lot of risk premium, I think, and the focus was the FX market because that was kind of ground zero for where all of this would play out. And so I think what we're seeing is an unwind of that. There's still a bit to go, but, euro could go up 1% and you could say it's risk premium. If it went up 3%, it would have to be something beyond that at this stage.
Steve, Michael Purves here.
Hey, Michael.
This is maybe a slightly bizarre question, but do you think Trump can make Europe great again? And what I mean by that is if he goes aggressive on Europe, will it put the European countries, for example, Germany, in a place where they're going to be more fiscally expansive than they have been in the past, and maybe even put in some reforms into their economies there? Is that a scenario that we should be looking at?
It could be, but I worked at the OECD 30 years ago, and the same structural issues that are still existing in Europe existed then. It's a generation and a half ago. I do think you're right, and we think you're right, that there's a chance that, say, if we have a change in government, not to the AfD, of course, but to the center and a stronger centrist government, that they will sort of ease up on the debt situation and they could do more fiscal expansion. If I had to bet on Europe changing policy, for whatever reason, they may change macro. They seem determined not to do the sorts of things that you and I would call structural, fundamental microstructural reforms.
Wow. Steve Englander, thank you so much for joining us this morning. Steve Englander, of course, of Standard Chartered. Michael Purves, thank you for joining us this hour. It's a great point because also I see today France is calling for major reworking of European regulations.
Right, exactly.
They are seeing the writing on the wall when it comes to Trump 2.0.
And you've also had ECB members, if I can jump in, Villeroy and Casimir both bringing up Trump in the context of it should be a wake-up call for Europe. So policymakers are already talking about the point you're making, Michael.
Exactly.
He's pushing them up against the wall.
Right.
And they're going to have to react.
Right. And they may even compete against each other within Europe.
So just quickly, do you think now's the time then to invest in Europe?
Not yet.
Not
we
yet.
got to watch it, but it could be an interesting upside surprise here.
Right. They're forcing them to basically get out of their own way, which is what I hear a lot from Trump administration officials. There's no growth in Europe. They need to figure it out themselves, or they're going to be the ones that get hurt the most when it comes to especially a trade war, because China's going to have nowhere else to go.
Right. Let's just add another voice to this. Christine Lagarde at Davos saying it wouldn't be pessimistic to say that Europe was in an existential moment. She talked about the deep reforms they need. We had the Draghi report. Maybe this is the thing that actually gets Europe to enact it, or maybe they just fight with each other.
All right, coming up to the program, another hour of Bloomberg Surveillance, Sarah Kunst of Cleo Capital, Bloomberg's Tyler Kendall from Washington, Savi Syth of Raymond James, and Norman Roule of CSIS. You're watching Bloomberg Surveillance on this Friday morning. U.S. stocks yesterday hitting an all-time high, the first record for 2025.
The 10-year right now is giving all the right signals.
I think the market has digested where we are right now.
A lot of that optimism is priced into the market.
People want to allocate to a little more risk, but importantly, they kind of want to get beyond the index level.
I'm a great believer in go and hunt where the others don't want to tread.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City for our audience worldwide, good morning. Good Friday morning. This is Bloomberg Surveillance. I'm alongside Danny Berger today. It's Anne-Marie Hordern, Sarah Hunt of Alpine, Alpine Saxon Woods, also joining us this hour. I'm back from Washington, D.C. John and Lisa are making their way back from the Swiss Alps, where everyone was talking about what was happening on the East Coast. In Washington, futures this morning are a bit softer, but yesterday, of course, the S&P 500 notched its first record high for 2025. So a little bit of a mixed picture right now, but this comes, Danny, as we are seeing the President of the United States in his first week of office pretty much touch, take your pick, what you want to trade, what you're invested in, pretty much touch every aspect of global financial markets.
You could say he tried to jawbone the bond market, talking about the Fed needs to cut rates. You could say he tried to jawbone, and I guess successfully, this oil market, saying that OPEC needs to lower prices. In all that, though, it's been a pretty calm market. I think of this thing that TD's Mark McCormick often says, that markets are serial monogamous. They can only concentrate on one thing at a time. And Anne-Marie, maybe the thing that they've decided to concentrate on is a softer tone when it comes to China. With Trump on Fox yesterday saying he'd rather not use tariffs, floating 10% instead of 60%, giving TikTok more days, saying they're not a national security threat. Perhaps this is what the market is just concentrating on and hanging its hat on.
Tariff man seems to be in negotiating mode. Here's the quote on Fox News to Sean Hannity last night, part 2 of that sit down in the Oval Office. Quote, "We have one very big power over China, and that's tariffs, and they don't want them, and I'd rather not have to use it, but a tremendous power over China." As an individual in this marketplace, talking to people, is that giving the markets a little bit of certainty that this is a negotiating tool? We're not going to use just, broad-based blanket tariffs. What out of what Trump has been saying, whether it's briefing with the press, talking to the world's global elite at Davos, what has he been saying that you've taken on and said, okay, this is going to be good for us for 2025?
So I think that looking for certainty at this moment is probably not, you're not going to get a lot of it. I think
probably
that I think there was a lot of relief that there wasn't this immediate, we're going to drop a bunch of tariffs on China. I think it was clear from the beginning that it was going to be a negotiating tool, but I think there was some concern that right out of the gate we would start with something that was a little bit more punishing. So I think that that's very helpful. I think the general feeling of we're going to be pro-business, we're going to be pro-this, it gives you a deregulatory push that makes people feel a little bit better about the prospects for growth. So I think overall that's the arching picture, but from a small thing, they're going to change around and they are going to continue to change around. And so that makes it difficult to pinpoint any one thing at the start.
I'm just convinced everyone on the East Coast has been too cold and their fingers have been frozen, so can't push those buttons to trade things. No, but I mean, you're right. We haven't gotten anything concrete. There's a lot of uncertainty. Markets are supposed to hate uncertainty, but we are still at all-time highs. What happens, though, in a week's time, to the point you've been making, Anne-Marie, when it is February 1st, this new deadline that Trump has set himself for imposing some of these
tariffs? Right, because the EO says April 1st when it comes to actually reviewing some of these trade policies. But Sarah, to your point, I think what this administration is trying to project to the business community is revolution of common sense. That's how he started his speech to Davos, and he keeps talking about this golden age, and a lot of that has to do with a lot of deregulation. As Danny said, markets are still at an all-time high, although futures this morning just a touch softer. I will say, though, markets are really leaning into this idea that Trump is saying that he doesn't want to have to use those tariffs. And of course, that's been huge in the currency market. Euro dollar this morning, 104. That is massive for global currencies. Not as good as the dollar, but we know this is a president who would be maybe a little bit happier with a weaker dollar. 10-year yield, 4.63%, exactly where Trump came into power on Monday. We were ending the week. And crude, just under $75 a barrel. We do have crude set for the first weekly loss this week. Trump jawboning the Saudis and other members of OPEC. Coming up this hour, Sarah Kunst of Cleo Capital with stocks at record highs, Syth of Raymond James as airlines see mostly strong demand to start the year, and Norman Roule of CSIS as President Donald Trump continues to pressure Russia to end the Ukraine war. Let's begin this hour with stocks mix on track for a second full week of gains as Trump appears to soften his China tariff stance. Some investors breathing a sigh of relief around signs the president is open to trade negotiation. Joining us now is Sarah Kunst of Cleo Capital. Sarah, thank you so much for joining us this morning. Is that what you take on from this first full working week we have of the new administration, that they're in negotiating mode and not full on put up the walls mode?
I think that with Trump, as long as there's money, there's negotiations to be had. And I think that, he is a New York guy, and he has come up understanding that the best way to get things done, he thinks, is to come in with a really big threat. And then when you walk it back, 60% tariffs makes 10 look okay and 5 even better. And then, he probably hopes that China will offer a sweetener there. And we're seeing that with Saudi Arabia saying, hey, we've got an extra $600 billion to give you. Don't look at us for tariffs. Move the oil price where we want it. And so I think that that's kind of a standard negotiating tactic. And I'm a little bit surprised that so much of the global community kind of blinked while playing chicken with that train. But it seems to be working out not as bad as people feared.
When it comes to things you're focused on, I know AI is one of them. And we did see Saudi Arabia talk about the fact that they want to invest a ton in the United States, $600 billion. Then Trump went to Davos and said, maybe make it $1 trillion. It'll sound nicer. A lot of that has to do with AI and data centers. And Trump said yesterday at Davos that he could sign the executive orders himself in terms to get the regulation approvals quicker to make these data centers. What's the new investment angle to something like AI that we've been talking about for years?
So I think that I have a really boring take on AI, which is give me a tech company that has been around at least 2 decades, doing foundational work in AI that's been public for years, and I'm interested. And so that's, the NVIDIAs, the Taiwan Semiconductors, ARM. I think Intel is going to have an interesting arc here, even with the new CEO. Oracle, certainly on the data center news, is part of that. So I don't think when you're talking about $100 billion, multi-billions of dollar investments that you're necessarily going to look at the earliest startups, although certainly there are a lot of really interesting early stage AI startups. I'm in names like Grok, which are doing some really interesting things around AI chips. But the reality is a lot of that trade for the near term is going to be in those legacy tech names who have been doing AI, who have been building these chips and building these semiconductors.
I love that you mentioned Intel, because right when you said that, Sarah, I thought even Intel, but yes, to your estimation, even Intel. There's been a lot of chatter, though, especially on the Twitter sphere, the X sphere, whatever it's called now, about DeepSeek, this new model that the Chinese have put out for everyone to use on AI, and that it's really advanced and that it looks really good. And China, by the way, TSMC right around the corner from them, the U.S. was supposed to be this moat, that we had really advanced AI and that we were the leaders here, but we don't even have some of the production capacity. So, Sarah, what becomes the U.S.'s moat in AI if it looks like China is rapidly advancing?
I would say get your AI news from white papers from PhDs, not from Twitter. But, the reality is that yes, there are really smart technologists in China. We see with DeepMind, that's a UK based company. And now Mustafa, who's running AI for Microsoft, that's a British immigrant who's moved to the US. And so we are not going to have a chokehold on every single talent, especially with the things like the H-1B visa fight. The US is not going to be the sole proprietor of smart people in AI, and that's fine. The question is, how do we make AI work for our economy? We know that often with tech, China and the US are very, very separate. And so great, let them have their developments. We're doing similar things. And I think the real question is, how do you actually make it make money? Because you can build these data centers, you can pour a ton of money in, but until you're seeing it actually make a difference in sort of, hey, is it easier, to file my taxes, or do I have to do less grunt work and bureaucracy day to day in my job? And you're really seeing gains there, you're sort of just throwing more money on the fire in this sort of arms race with the rest of the world that really benefits the Sam Altmans of the world, but less so kind of the average mom and pop retailer or consumer.
I promise, Sarah, I get more of my news sources than just X. Let me just set that record straight before anyone is worried. But on this point, it brings us back around to the Stargate announcement of this money being poured in with Oracle, OpenAI, SoftBank coming in. Oracle rallied decently on it. It's up 16% on the week. What do you understand as the ultimate goal, to the point that you are making? What does it actually accomplish, and what does it look like? Is it worth the excitement that's starting to be priced in?
I think that a lot of these legacy tech names, they've had too little excitement priced in. When the world was focused on sort of social media, social networking, deeply consumer, not as sort of tech-driven tech names, I think a lot of these names got overlooked. So I would look at the pricing and the price movement slightly different than what they're actually building and doing. If there's a commitment to AI, which there certainly seems to be globally, then you do need data centers. One thing I like, and it's a little bit different than what Oracle's doing, but one thing I like about all of this is we're bringing nuclear back online. We're looking more at energy, and that's something that's important in the U.S. When you look at how cold everyone is and how high everyone's electric bills are going to be from this month, but it's also important in places like Europe, both for energy independence from places like Russia, but too, you look at the prices in the UK, and so having if AI sort of spurs this revolution in clean energy and infrastructure, I think that is good. I think over time, AI will be really important and useful for us. I don't think we're there yet. And I do think that these companies need a new story to tell the street after the last couple of years of everyone just being thrilled. I think there was one quarter where Papa John said the word AI like 30 times in their earnings calls and their stock went through the roof. That trick doesn't work as well anymore.
I agree with you, and I think it's really interesting that you mentioned the sort of use cases, because in the end, we have to be able to show that there's productivity, which is the big promise of AI. But I think getting back to the energy side, what's really interesting to me is that you can have this push about permitting data centers. You have to change the energy situation, because that's one of the biggest bottlenecks. And I think that that's someplace where we're starting to see some expansion. Is there an area that you're looking at within that sort of ancillary piece off of AI that you think is the most interesting?
I think that there's going to be a lot of just sort of foundational sort of shift to energy things that we have sort of written off, right? We all heard about Chernobyl and said, okay, I guess that we don't want frogs with 20 heads. And it's like, okay, that was a long time ago. The technology has moved forward, and this is not something that needs to sort of curtail how we think about developing energy. So I'm interested in nuclear. I'm interested in bringing more renewables to the grid. And I also think things like hydro are going to be really interesting and important. And you see that as a big piece of where people are going globally with energy. So I think that it's an everything thing. And it's good for far beyond just AI, but we have to have that to be able to make AI development sustainable, both cost-wise and as a cost to society.
That is a big issue, I think, the cost problem. And I think that that's also someplace where building everything is very expensive. So if we start to think about what is potentially positive and what gets the market excited about what's going on right now is if you bring some regulatory issues back and you allow things to get built for less, because building nuclear is now insanely expensive. And I think that there is some place that has to change. And that's on a technology level where things can start to get better and we can start to use smaller reactors like they use in parts of Europe, as opposed to the sort of larger one-off areas that we're using now. What are the other sectors that you are fascinated by as we go through this, just as picking a brain from one stock picker to another? Kind of what else do you think is really interesting here as we start to see what this new administration brings?
So my inbox has been flooded. I'm a private company investor in venture. My inbox has been flooded with people who are buying and selling secondaries right now in private names. I haven't seen this level of it for years. And so I think that, we don't know when that IPO window is going to open. You look at the filings and they haven't quite ramped up. I think people are waiting a little bit to let this administration settle in. But the reality is that the last SEC and FTC heads made it really hard for people to buy and sell companies to go public, and you have a huge backlog of that. And so while we haven't seen the Stripes of the world commit to any firm plans, we do see names like Klarna, that have raised their hand and said, we're going to go public soon. And I think that we are soon to see a dam break there. And that we're going to see just a ton of really interesting companies come to market, buy and be sold. And so right now that those secondary trades are ramping up at a really crazy rate, which to me indicates that people expect that this year we're going to see a lot of filings.
It's a great point. On this program, the JetBlue CEO said it couldn't get any worse when it came to the FTC and basically the regulatory environment of wanting to get in and do deals, Sarah. Thank you so much for your time this morning. Sarah Kunst of Cleo Capital. Danny, at one point she also mentioned, I'd love to pick up on, how much more is it going to cost to heat your homes because it is so cold? And I have literally the smallest violin for anything John and Lisa say about how tough Davos was, because it's actually colder right now on the East Coast than it is in Switzerland and the Alps.
I think you could maybe even argue that there was more snow in New Orleans and Texas than there were on the Swiss Alps, too. I got to say, I never understood why they did Davos in the winter anyway, because you want to run away to somewhere warm. I've gotten so many people saying, hey, we're doing a conference in Miami next week. Do you want to come? So for all the bosses that are listening, please let me go to conferences in Miami.
And given the fact that pretty much everyone was just talking about President Trump, I can only imagine at some point there might be a conference in Palm Beach, just a little bit north of Miami. All right, let's get you an update on stories elsewhere this morning. We're watching. Here's Sonali Basak with your Bloomberg Brief. Hey, Sonali.
To say it, guys, I will be in Miami this week. Leaving tomorrow morning. But for now, we are watching Verizon shares. They were higher in pre-market. They are now dropping about 2.3% after the communications giant's fourth quarter topped estimates. Verizon saw big gains in new mobile phone and broadband customers. They added over 500,000 monthly subscribers, and they did top expectations by about 70,000. Broadband was a bright spot, adding over 400,000 net subscribers, nearly double the amount that analysts had predicted. Also watching Boeing because there's more trouble for the plane maker. They suffered more losses and charges in the preliminary fourth quarter revenue report. In a surprise announcement, the aerospace giant said its sales missed expectations. Last year's strikes had impacted results. Boeing is set to deliver its full earnings on Tuesday. Tesla unveiled an update to its best-selling Model Y in the U.S. and Europe in an effort to revive sales. The redesign borrows elements from the Cybertruck, including full-width LED bars, and also featured improved aerodynamics and better soundproofing. The EV maker looking for a turnaround after reporting its first annual sales decline in over a decade. And that's your Bloomberg Brief.
Thanks so much, Sonali. Up next in the program, Trump versus the rest of the world.
My administration is acting with unprecedented speed to fix the disasters we've inherited from a totally inept group of people. My message to every business in the world is very simple. Come make your product in America.
Make your product in America, he says. You can get a 15% corporate tax rate. Not quite sure Congress is on board with that just yet. That conversation coming up next. You're watching Bloomberg Surveillance. Good Friday morning. Equity futures this morning a little bit softer, though we did have our first record high yesterday with the S&P 500. We're down just slightly. I will say global markets and global currencies are taking a huge relief off the fact that Trump is basically sending a signal when it comes to tariffs, at least at this moment. This can all change. That's the caveat. But at least at this moment, it looks like he wants to be more in the negotiating chair. Under surveillance this morning, Trump versus the rest of the world.
I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. I'm surprised they didn't do before the election. That didn't show a lot of love. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. The EU treats us very, very unfairly, very badly. My administration is acting with unprecedented speed to fix the disasters we've inherited from a totally inept group of people. My message to every business in the world is very simple. Come make your product in America.
Trump with a wish list and a grievance list yesterday. Here's the latest. He's laying out his, quote, America First agenda in virtual remarks to world leaders at Davos. Today, he's set to visit North Carolina and California while his cabinet continues to take shape in Washington. To wrap this all up for us, Bloomberg's Tyler Kendall joins us now. Tyler, so basically Donald Trump leaving the White House for the first time he's in office for the second time around, and he's making a push domestically. What's in store for this trip?
Yeah, good morning, Anne-Marie. President Trump expected to take off in about 2 hours' time. First stop is to Asheville, North Carolina, where he'll tour damage from the hurricanes that hit that region late last year. Then he's heading to California to see the ongoing devastation from the wildfires there. The LA fires expected to be some of the costliest in U.S. history. The latest projections from AccuWeather putting economic loss anywhere between $52 and $57 billion. Now, President Trump has threatened to withhold federal aid from California if the state doesn't make some changes to its water policies, alleging that they could divert more water from the northern part of the state. California officials say that's not possible, nor is that the problem. But I was catching up with one Republican aide on Capitol Hill yesterday who said the general consensus is that supplemental disaster assistance ultimately will be passed. But this idea of conditioning it on either unspecified policy changes or even tying it to a vote on the debt limit, something that has been floated here in Washington, is going to prove politically difficult. Anne-Marie, House Democratic leader Hakeem Jeffries yesterday told reporters that any such provisions would be a non-starter for his party.
Speaking of political difficulties, Tyler, these nomination hearings have been running quite slow. The Democrats have been successful in trying to slow down the process. We have Hegseth moving on to the next step, surviving the procedural vote. But to what degree is it indicative, the slow pace that we're going at the moment, for the rest of Senate confirmation hearings?
Right, exactly, Danny. So we are expecting a final confirmation vote late tonight, potentially even into tomorrow, for Pete Hegseth for Defense Secretary. You mentioned there he narrowly passed a procedural vote. We have to remember that in order for final confirmation, these nominees need a simple majority in Congress. Republicans have a 53-seat majority, which means that Hegseth, who lost 2 Republican votes yesterday, Senator Susan Collins and Lisa Murkowski, can really only afford to lose 1 more vote. That would even put it in dicey territory, leading to a tiebreaker and potentially Vice President J.D. Vance casting his first ballot in the chamber that way. But it is raising questions for next week as we start to get some of these firm confirmation dates for some of the more controversial nominees, including Tulsi Gabbard, Kash Patel, and RFK Jr.
What is the strategy of slowing things down? How does that help the Democrats right now versus allowing things to proceed, which they ultimately will because of the majority in the Senate? How does that play out, and what do they think that they're getting for that?
Right, exactly. So Senate Minority Leader Chuck Schumer has said that this needs to be the way forward for Democrats so that they can both make the point, but also kind of muck up the process. We know that President Trump has floated this idea of potentially doing recess appointments, something that Senate Majority Leader John Thune has indicated that he would like to avoid as he tries to take control of the chamber as the new leader. Now, Republicans have a lot on their agenda, but besides for trying to confirm these votes, they're trying to get through a reconciliation package to tackle some of Trump's bigger priorities, including immigration, energy, and also tax cuts bills. So this idea of just slowing down the chamber as a whole could pose larger problems to Republicans as they try to tackle their agenda.
Tyler, thank you so much for your time this morning. That's Bloomberg's Tyler Kendall looking out on basically what to expect this weekend. Trump hitting the road, domestic focus, but she ended there on reconciliation. And I was struck, Sarah, by what Trump said yesterday at Davos. If you make the products in the U.S., he repeated what he said downtown at the Economic Club of New York on the campaign trail, you'll get a 15% corporate tax rate. If not, you'll basically get punished. Do you start baking in a 15% corporate tax rate?
I think that's another one of those areas where this is a good start to say, hey, come and do this. We're going to give you a break. I don't know that he can do that without Congress. So I think that there's a lot of information that needs to come through there. But I think the idea of saying, come in here, it's almost like saying we're going to put the U.S. as a tax-free zone like you do in certain states. I think the idea is we would like to get more manufacturing back. We would like to get more things back here. And I don't know that those hard numbers are something you would ever bake in at this particular moment in time. But I think that ultimately you have to sort of see where that goes and whether or not that strategy is successful.
I guess the thing you can take solace, though, in, and this is something you've talked about a lot, Anne-Marie, is that the sequencing matters. And what we've gotten is a lot more chat on this idea of taxes, of the carrot, come in, we'll lower your taxes, versus tariffs. Again, him talking on Fox, saying he'd rather not use them. So in terms of what the priorities are and what importance are, even if we don't have taxes in hand at this moment, even if it requires Congress, it seems that the list of things that they want to get done, perhaps that comes above some of the tariff measures.
True, and it's a lot of spaghetti being thrown at the wall and seeing potentially what sticks and what Congress can get done. But it's a great point on the tariffs. Potentially, they know the sequencing. We have to get these tax cuts done before we can really put the walls up. Coming up in the program, we continue this conversation and more. Syth of Raymond James as airlines see strong demand to the start of 2025. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. We are 2 hours away from the cash open. Equity futures this morning, as Jonathan Ferro would say, as he makes his way back from Davos, Switzerland. No drama here. Yesterday, though, S&P 500 futures notched its first record high for the year. There's a lot of policy coming out of Washington, D.C. that the market certainly likes, especially when it comes to traders clearly taking a sigh of relief, especially in places like Europe and Asia, when it comes to the signaling from the White House that right now Donald Trump doesn't want to use tariffs. He will if he has to, but he doesn't want to go there. All right, let's get you some of the other individual morning movers this morning with Manus Cranny. Hey, Manus.
Anne-Marie, very good morning to you. Don't forget First Buddy popped in to see Boeing as well. It's the big take story this morning. But the numbers are so bad, they decided to pre-announce. This is Kelly Outberg going for a mini kitchen sink. They've done it once. This is a mini one. This is a graveyard of charges on commercial, on defense. Defense, $1.7 billion of a charge there. So they've still got $30 billion on cash. The stock's down 1.4%. The risk is this, you get cash burn. Yes, they raise capital, but is that enough? Is that going to see them through the year? What are they going to do with some of these defense contracts that are a bit weighty on them? Do they need to offload them? It's always good when the First Buddy pops in. Have a look at Texas Instruments. This company makes a mammoth amount of chips. 70% of their revenue comes from industrial equipment and vehicles. Yes, the top line was grand. It was $4 billion, $4.01 billion, way ahead of the street at 3.86. But it was about the guidance. They're going to make 94 to $1.16. Even if you take the middle of that point, it's still way below the estimate for the first quarter. So this is about a signals chip slump, which is enduring 9 straight quarters of a drop in sales. And they don't have the magic sprinkle sauce, that magical AI chip that can take them up to the heady levels of NVIDIA. I'll leave you with Novo. It's all about weight loss. This is the stock performance this morning. Their new drug is emiquatin. Experimental, you take the shot over 36 weeks. If you take the maximum dose, you lose 22% weight loss. The placebo, I think I got the placebo, you gain 2%. Bloomberg Intelligence say, look, this reinvigorates the head-to-head challenge for the GLP-1s between themselves and Eli Lilly. So it is really about sort of building the moat again around Ozempic for them at Eli Lilly.
Manus, I'm just going to say, thank God you got the placebo. That is something you do not need. Manus Cranny, thank you so much for wrapping up those individual movers this Friday morning. Under surveillance, President Trump reiterating, quote, massive tariffs on Russia and, quote, big sanctions if President Vladimir Putin doesn't end the Ukraine war. Trump also telling a crowd of world leaders and executives at Davos he's looking to partner with China to force a settlement. Interesting here. Trump is not backing down when it comes to Putin. He wants to meet him at the table, but he's saying the onus is now on you, Putin. And it seems that he wants to use China, which may be why the tariff story is so interesting this morning. He wants to use China to put that pressure, I'm sure, not just on Putin, but also on Iran.
Right, because he can't come to China and say, we're slapping you with 60% tariffs. We're shutting down TikTok. And, oh, by the way, can you help us? And can you talk to Russia and give us a hand here? It is a different tone. Not just on the China front. You were kind of getting at this, Anne-Marie. The fact that he's placing the onus on Russia. A campaigning Trump had said, I can stop this war on day one. And a lot of that rhetoric had surrounded Ukraine. Maybe giving up more territory, maybe being more amenable to what Russia would have wanted from them. Instead, it's a different scenario. It's one where Trump is really looking at Russia to be the one that does something to end this war instead of Ukraine.
Well, I think it's one of those things where he flips the script a lot, right? So you start with this and then you go to that. And then that's what leaves people guessing. And that's the idea of, you know, on the positive side, the idea is that you're negotiating and you're moving around so fast that people have to keep reacting to you. On the downside, it means that no one really knows what's going to happen and when that's going to happen and what it is. When you say I can fix X, how do I actually fix X, especially if I'm now flipping this? So I think it's just part of what we're dealing with and part of also the very beginning of this, which is, as you were alluding to earlier, a fire hose of information.
Fire hose of information when it's coming from Trump 2.0. This is now Trump White House. It's going to be 7-15 news cycles in a day. But the point you're making there is so important. Unpredictability when it comes to Trump foreign policy, and you've said this a lot, Danny, is a feature, not a bug. He does it on purpose. Also, we're watching this morning. Republican senators are still working to get Trump's cabinet picks confirmed. A vote is expected this evening on defense pick Pete Hegseth. And if lawmakers stick around through the weekend, Treasury pick Scott Bessent and Homeland Security pick Kristi Noem. Several other Trump nominees set for confirmation hearings or votes next week, including RFK Jr., Pam Bondi, Kash Patel, and Howard Lutnick. I think what's so important about this is that you see that for some of these, it's it's been easy. Senator Marco Rubio quickly became Secretary of State. Scott Bessent in the next few days will be confirmed. But until we get someone like Howard Lutnick, Jamieson Greer, all these individuals in place, how is he going to even enact his tariff policy?
Yeah, certainly. And maybe, again, February 1st looks like less of a realistic deadline, the one that he set on himself. Maybe it is April 1st because he needs those people in place. That's why I think also the confirmation pairing of people like Howard Lutnick are going to be really interesting, because the narrative at this moment has been the adults are in the room. It is Scott Bessent that has the ear of the president. And that's why you don't see the most extreme of tariff policy coming down. What do we hear from Howard Lutnick in that confirmation hearing? Do we hear, as Terry Haines has said, the team of rivals and maybe some different color that we could get from Trump come next week or even closer to April 1st? That, again, it's not just, oh, the bark is worse than the bite, but actual some bite that he's going to have a new ear of once these people get confirmed.
Well, and I think that while they're waiting to get confirmed, they can certainly be talking, right? And that's sort of part of what's going on is, yes, those official confirmations haven't come, but it doesn't mean that they can't be talking and advising and doing whatever. And if you look at the February 1st, maybe that's now I've made some determinations and here's what I want, as opposed to here's what's going to happen. I don't know what the answer to that is, but I think that giving that a time frame also possibly pushes people to act faster. It's hard to tell because, again, the unpredictability is the base case.
You're right, though, Danny, to say that a lot of the onus is being put on Scott Bessent as really the adult in the room. Every conversation John and Lisa had, whether it was CEOs like Ted Pick, and they asked about Trump 2.0, immediately executives said, we feel really confident that Scott Bessent is going to be running the Treasury Department. Hopefully, potentially, he'll get confirmed this weekend, at least for market clarity. But when it comes to things like what Terry Haines is talking about, these cast of rivals, how much is he going to potentially have to fight the Peter Navarros or the Howard Lutnicks when it comes to policy?
This thing, it works until it doesn't. The reason that we are saying that the adult is in the room is because what we've heard from Trump is different than a campaigning Trump, is different than a Trump on the campaign who said on day one he's going to take action, that he could slap tariffs on really quickly. The fact that that hasn't happened quickly, again, has been pointed to this, that it is Scott Bessent having the ear. So it works for these markets until it doesn't, and have we just lulled ourselves into a complacent state?
Also under surveillance this morning, Tesla. They're unveiling an updated version of its Model Y in the U.S. and Europe in a bid to boost sales. The EV maker earlier this month reporting its first annual sales decline in over a decade. So Elon Musk does a lot of business in China, but they're also making a lot of competition for him in other places.
I think this is so interesting that he's focusing efforts, I mean, why wouldn't you, on the U.S. and Europe? But does it show a shift to focus more on the U.S. and Europe than China, a place that he has the ear of policymakers? Look, we know he had a conversation with the vice president of China when he came for the inauguration, but he is in a scenario where help from policy from the Chinese will only get you so far. You have the BYDs of the world that are really eating Tesla's lunch. Even if you have the favor of China, even if you can get something like FSD more quickly into that market, doesn't matter when China is so advanced and more cheaply priced at this moment. So maybe you kind of have to concentrate on American and European markets.
Well, I think that one of the knocks on Tesla has been that they hadn't refreshed a lot of the models, especially in the U.S. And I think, I mean, yes, BYD is everywhere, and their cars look beautiful, and they're much less expensive.
And they're $10K.
So there's that aspect of it, too. But I think that, to the extent that you need to refresh that, and you also had this massive first wave of adoption for people who really wanted an EV. And I think what the world is seeing right now is that absent both government help and or regulation, there is a limit to how many people want a pure EV as their only vehicle or as their first vehicle. And now you have to figure out how to make that more palatable. And this is where some of the hybrids and other things come in. And Tesla's obviously not going to go down the road of hybrids, but to the extent that they have to now have something that's a little bit more exciting, because they came out first, it was very exciting. And then, other people start to get in there. And also you lose that first wave of first adopters.
Especially if they want to hit the sales target that they talked about in the fall, in the earnings call. Elon Musk said 20-30% more growth in Tesla vehicles this year. Well, it remains to be seen. All right, we're going to turn to airlines now. United and Delta both seeing better than expected demand to start the year, boosted by European travel and customer demand for premium options. American, however, still working to win back business customers as it struggles with high operating costs. Savi Syth of Raymond James writing, the common theme has been strong revenue trends to close out 2024, with these trends improving further into the first quarter of 2025. An uptick in corporate travel and industry capacity discipline appears to be driving this strength. All right, so let's get right to it. You have a lot of optimism going into this year when it comes to the airlines, but I want to start at the challenges of 2025, especially when it comes to things like the weather. How much has this hurt the main carriers?
Hey, yeah, Anne-Marie, it's definitely been a challenging start to the year, as you can see. And if you look at across the board, you're probably having about roughly 5% cancellations on average. That compares to about 1 to 2% cancellations in the fourth quarter, closer to 1%, and even 1% cancellations last year. Like, it's still early in the quarter. And we'll see how the rest of the quarter progresses. And the silver lining is it is January. Not a lot of travel happens. It's bad for those folks who get disrupted, but the airlines also have the ability to reaccommodate passengers more because the planes aren't as full. So a rough start to the year, and then you put the LA fires on top of that. But we'll see how the quarter progresses. It's still pretty early.
Well, Savi, apparently the good news is we're all getting on a plane to go to a conference in Miami for whatever reason.
Well, Shanali is.
Yeah, at least Shanali is. So that's one person for them, sadly. We all wish we were in that place too. But there was some confidence coming from these airlines, especially the ones that are international and have a really solid premium up offering. So what went wrong with American, Savi?
Yeah, if you look at American, their revenue guidance beat expectations just as much as you saw at United and Delta. So I think they're seeing the same strong revenue benefits that their competitors are seeing. Domestic, transatlantic, really strong, and premium doing really well for them as well. I think with American, it was a little bit on the cost side where the miss came in. We were all expecting costs to be a little bit higher. It was just a lot more concentrated. The year-over-year pressure was a lot more concentrated on the first quarter. If you look out to the full year, it's a lot closer to expectations. So I think with American, it was a little bit more timing, but the top line still very encouraging.
If I think about the cycle and the problems that the OEs have had, both Airbus and Boeing, on delivering planes, because a variety of different issues, what is the point at which that stops and you start to see that capacity come in? Because I can imagine some of the costs may be maintenance costs because we are running planes that are older because we're having trouble refilling that. What happens both to pricing and to capacity when that bottleneck starts to ease?
Yeah, you're right. The maintenance costs have been a burden, and not just maintenance costs, but the uncertainty around the timing of when your aircraft will return. With the time it takes for maintenance taking a lot longer than it has in the past. But what I would say that the biggest pressure for airlines is labor costs. So, even if you see OEMs catching up and deliveries starting to come online, I think you're going to see good capacity discipline in the U.S. because at the end of the day, all these airlines need to pass through their higher labor costs. And that's what we're seeing here today, is just a supply environment being rejigged to be able to support fares that cover their costs. And we've seen significant labor cost increases in the U.S.
When we had that pre-announcement from Boeing yesterday, Savi, we're still seeing the reaction in markets today. And you get this commentary that you got at their last earnings, that it's a kitchen sink moment. Finally, we expected it to be bad. They're just putting it all out there. How many of these can we have? At what point do we expect Boeing to actually start to turn around cash flow?
Yeah, it's a big task. Now, I don't cover Boeing, so I don't have a view on when they might stop taking charges. But it's a big task on hand. I would say, talking to the airline management teams in the U.S. and Europe and Latin America, there's a lot of confidence in the new CEO and his ability to turn things around, but it does take time. So this does feel like, we're maybe the low point, but how quickly we get off the bottom is more the question that everybody has, and I don't think we have a clear answer yet.
Savi, how much is the currency market dictating where people are going and they're traveling to?
It's definitely benefiting transatlantic travel. You saw that much of last year, or even, some Pacific, like Japan has been a very popular destination. And I think the US dollar has been a big driver of that. So the US dollar remaining strong is a good thing for airlines with long haul international travel. And supportive of some of these kind of strong margins that we've seen in the regions.
Totally. Europe looked so cheap this summer. I think a lot of people are getting excited about that. Syth of Raymond James, thank you for your time this Friday morning. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Bassick. Hey, Shonali.
Hey, Anne-Marie. We're looking at American Express. It posted a 12% increase in profits for the fourth quarter. Consumers spent more than analysts expected over the holidays, with transaction volumes on credit cards and other products issued by the firm rising by 8%. Meanwhile, fourth quarter net income came in at $2.17 billion, which was slightly missing estimates. The company expects full-year revenue to grow between 8 and 10%. Also watching shares of Novo Nordisk rising in European trading after the pharma company reporting strong results for its weight loss injection. Its new experimental shot delivered as much as 22% weight loss in an early-stage trial, boosting investors' hopes for the drug maker's pipeline. The shot combines two mechanisms for weight loss in a single molecule, unlike its previous treatment, Carisigma. Novo is also studying a pill version of the compound for future release. And Kendrick Lamar will have company during this year's Super Bowl halftime show. The Pulitzer Prize-winning rapper revealed that singer and frequent collaborator SZA will join him during his Super Bowl performance. While this will mark SZA's first appearance during the halftime show, Lamar first made his Super Bowl debut in 2022, you may remember, alongside Mary J. Blige, your favorite Danny, Snoop Dogg, Dr. Dre, Eminem, and 50 Cent. That's your Bloomberg Brief.
I'm still amazed that Kendrick Lamar won the Pulitzer Prize, but I'm pretty sure that year the Grammys didn't give him the best album. They gave him the best rap album, but they didn't give him the best album. I've seen Kendrick Lamar in person. I'm also a fan of SZA. Shonali, we need to educate you on some of the hip hop out there. But this is going to be an exciting halftime performance.
It's unfortunate for Drake. I just think about this. Drake has lost the battle. It is Kendrick Lamar reigning supreme everywhere. And I'm excited for this halftime.
First rapper, first non-classical or jazz artist to ever be awarded a Pulitzer Prize? Yeah, I think he won. All right, less of that, more of this. Up next, investing in America.
It's also reported today in the papers that Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion.
Ooh, $1 trillion, maybe, coming from Riyadh. That's next. You're watching Bloomberg Surveillance. Under surveillance this morning, investing in America.
It's also reported today in the papers that Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. My message to every business in the world is very simple. Come make your product in America, and we will give you among the lowest taxes of any nation on earth.
Here's the latest. President Trump telling world leaders in Davos he will push for a bigger U.S. investment from Saudi Arabia. The kingdom's state-run news agency saying Crown Prince Mohammed bin Salman made a $600 billion pledge to Trump on Wednesday. Former senior U.S. intelligence official Norman Roule calling the pledge, quote, powerful evidence that Riyadh believes the U.S. will remain its foundational security and economic partner for decades. Norm, thank you so much for joining us this morning. He's also part of CSIS. When it comes to the Saudis investing this amount of money into the United States, and now Trump upping the ante and saying maybe we can get to $1 trillion, like the way that sounds better. At the end of the day, is just as Riyadh choosing Washington over Beijing?
Good morning. In part, this is Riyadh choosing Washington over the world, but this is also Riyadh choosing the American high-tech sector over the world. Saudi Arabia's drivers are the success of the Vision 2030 transformation of its society as well as its economy. It believes that artificial intelligence will accelerate that process, provide jobs for a rising generation, transform the kingdom's industries, and all of that goodness, all of that power will come from a long-term relationship with the United States.
It's not the only place that Trump made headlines when it comes to Saudi, Norm. He also said that he would ask Saudi to lower the price of oil. Is that relationship strong enough? Is what Saudi gets out of the U.S. when it comes to economic security, some of the things you're talking about, enough of an incentive for them to act in a way that might be against some of their economic benefit?
Well, it becomes more complicated. First, this is an OPEC Plus decision. There are some OPEC Plus members that might be willing to produce more, but some are at capacity. So this really just leaves Saudi Arabia, the Emirates, and Kuwait. But there's a bit of a tension here. The lower oil prices become, the less revenue Saudi will have to invest, not only in its Vision 2030 domestic plans, but within the United States itself. So I think you're looking at oil prices that once they would say reach the $60s, really cutting into the amount of money that Saudi Arabia would have to put it to meet its investment promises to the Trump administration.
That's one of the contradictions of asking for more production if you think it's going to lower prices, because in the end, what you end up doing is saying, okay, where's that volume versus price argument? And so I think that they probably have the most spare capacity, but you could also envision that there might be a small give back on production because they are holding some back as opposed to a major give back on production. Do you have any thought about how that actually plays out in the real world as opposed to just a request?
Sure. The kingdom has two primary goals: market stability and maintaining a capacity to be a swing producer driver to prevent any sudden shifts within the market. That will drive a relationship with Russia because they have a capacity to impact the market. But the kingdom actually has less control over what happens in the United States in terms of its market. So we're sort of reaching the end or the high point of what fracking can do. The kingdom can produce probably another 1 million or 2 million barrels on the market. The Emirates could do the same thing, and I think some from Kuwait. But I think in the end, stability in the market is going to be the driver that shapes where OPEC Plus goes.
Norm, when it comes to the three big adversaries of the United States, China, Russia, and Iran, we've seen President Trump in his first week really focus in on Russia and putting the onus on Putin to get to the table. What's the strategy when it comes to ending this war?
Well, I think the strategy is clear. First, he has assigned General Keith Kellogg, a very experienced national security official, to work this. And General Kellogg's work is continuing, but it is low profile. Second, he has gone to the Ukrainians and has said, you need a deal. But at the same time, just as Trump encourages NATO to increase its spending against Russia, he has encouraged Ukraine to enlist 18 to 25-year-olds in its army. So I think Ukraine, he believes, is ready for a deal, but Russia has yet to come to the table in a meaningful way. And that explains the president's comments on the pressure he would bring on Russia's economy, which are real. I mean, Russia is spending a tremendous amount of money on this war. We're talking over 40% of its budget is now devoted to military issues. Its labor market is being squeezed to the limits. You're looking at a collapse of foreign investment. It's lost markets. I mean, this is really a tremendous blow to any of the world's economy. And I think the president's views of I will put more pressure on that economy is how he plans to bring this forward.
Norman, thank you so much for your time this morning. Norman Roule of CSIS and, of course, former senior U.S. intelligence official Sarah Hunt, thank you so much for joining us this hour. What struck me at the end there is Norm made another good point, which is he's also telling the Ukrainians they need to do more. And what did he say last night in that Sean Hannity interview? He said Zelensky is no angel.
But Zelensky has changed his tone when it comes to the U.S., too, talking about making a deal. So I think he also kind of understands this new environment that he's dealing with, too.
Yeah, push-pull. The next 100 days is going to be fascinating. Coming up in the program, Jay Pelosky of TPW Advisory, Kathy Bostjancic of Nationwide, Ashok Bhatia of Neuberger Berman, and Libby Cantrill of Pimco. You're watching Bloomberg Surveillance.
having Donald Trump come into office is a very welcome change, and we hope that we will let market forces drive.
Generally speaking, he's looking to stimulate investment in the United States and really foster more innovation, more growth.
A lot of the Americans at the moment are actually saying, I only want to be in the U.S.
Every marginal dollar around the world is looking at the U.S. as a significant opportunity.
A very strong U.S. economy is a good thing for the world and the world economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City for audience worldwide, good morning. This is Bloomberg Surveillance alongside Danny Berger. I'm Anne-Marie Hordern, also Jay Pelosky of TPW Advisory joining us this morning. As Jonathan would say, it's Friday, so we got to get you to the weekend. John and Lisa are making their way back from Davos. They'll be back with you Monday morning. Markets this morning really relatively smooth sailing. We did have a fresh record high yesterday, the first for 2025. So really a rebound for what many were saying a dreary start to the new year. Now we're back into the fresh record mode. And while Jay Pelosky, I know, doesn't totally agree with you and I, Danny, we have heard nonstop policy proposals, darts being thrown when it comes to potentially what we could see out of this White House, and everything from jawing Jay Powell on interest rates to a realignment in trade and potentially a softer tone when it comes to those tariffs.
But again, maybe this is a market that is a serial monogamist and can only concentrate on one thing at a time. And the thing maybe it's decided to concentrate on is a softer tone when it comes to China. Or, as Ian Lincoln of BMO put it, this week was all about event risk. It was about inauguration and the many executive orders that we could see coming from Donald Trump. And there was an expectation that we would get something extreme. We didn't get that, so maybe the market is just sighing relief that it's a calm week and we can continue on without the drama.
Jay, do you like what you hear coming out of the White House?
Frankly, we're not paying a whole lot of attention, right? Because the president...
You might be the only one.
Yeah, and it's working great. I mean, it's been a great start to the year for us. And so, look, the president says many different things at many different times. That's a fact of history. You know, the job honing of Powell, that brought me back like 6 or 7 years. I'm like, wait a second, I've heard this before. I know interest rates better than anyone. I mean, okay, some people can pay attention to that. That's not really of interest to us. What's of interest to us at TPW Advisory is the melding together of two of our main themes. The first is our global long cycle, right? A long cycle of economic growth. And the second is our tripolar world of competition between Europe, Asia, and the Americas in the three critical areas of AI, climate, and defense.
When it comes to that point, yesterday on China, Trump did say this: we have one very big power for China, and that's tariffs, and they don't want them, and I'd rather not have to use it, but it's tremendous power over China. Is that music to you and your firm's ears?
Well, look, the way we view the world is that this tripolar competition is in those three areas. China has led the way in climate with its industrial policy. It now dominates the climate space. The U.S. tried to respond under Biden with the CHIPS Act, Infrastructure Act, IRA. One of the new president's first moves was to cut the funding of the IRA and the Infrastructure Act. And so now we're looking for Europe to respond. And our view is that with the German elections coming up, Germany will respond because it has to. It's been stagnating for 2 years. We expect China in March at the NPC meeting to provide further stimulus because it has to, not because of Trump, not because of Trump, but because it faces deflation. And it understands, yes, as a corollary, it has a massive trade surplus, which does leave it open to tariff risk. But they have done a great job of diversifying their exports away from the United States. And we've read estimates that even with 60% tariffs, the impact on China would likely be roughly 1% of GDP. Okay, now 60% tariffs not going to happen because that would send inflation through the roof, right, and blow up the budget deficit and all the other things. So to us, the two things that matter are fiscal space. Who has the fiscal space to compete in AI, in climate, in defense, and who has the governance capacity to do so? The U.S. has neither in this administration. It doesn't have the fiscal space, 6% budget deficit, doesn't have the governance capacity, and therefore we are looking for a broadening out geographically of the global growth cycle. Germany stimulating, China stimulating, better global growth, commodities breaking out, super bullish for our thesis. And what we're looking for next, and this is where we may see it in the next week or two, non-U.S. equities break above their resistance levels and signal that the global bull market, global bull equity market is also broadening out.
Well, what is doing well right now are U.S. stocks. Yesterday, it had its first record for 2025, another record for the S&P 500, although futures this morning are relatively unchanged. The global bond market, the U.S. 10-year yield there, 4.64%, basically starting off the week ending the week where we started off. And then Jay Pelosky there just talking about crude. We are higher on crude, even though the President of the United States is telling OPEC, add more barrels to the market. Coming up, Jay Pelosky of TPW sticking with us. Global stocks on track to end the week at record highs. We'll get more of his thesis. Kathy Bostjancic of Nationwide looking ahead to the first Fed decision of the year. And Libby Cantrill of Pimco on President Donald Trump's economic agenda. We begin this hour with stocks. Mixed, major average on track to close out a second consecutive week higher. Some investors breathing a sigh of relief as President Trump seems to back off aggressive universal tariffs. Jay Pelosky of TPW Advisory saying, we anticipate year 3 of bull market type U.S. equity returns. We believe much tariff risk has been priced in. We remain singularly focused on the dollar. Common wisdom holds that tariffs are USD bullish. We are not so sure. Jay joins us now. Not so sure. The one place that is, even if you're not listening, the one place that is listening to Trump loud and clear, though, is the currency market.
Yeah, and look, the dollar is key to us, right? If the dollar rolls over, that's bullish for the non-U.S. equity exposure that we are focused on for 2025. Our feeling is that, as we wrote, as you noted, that the U.S. is going to be single-digit type returns for this year. That's what typically happens in year 3. Bull market needs to rest. Earnings growth, no room for multiple expansion. As we wrote in our monthly, the title was American Exceptionalism at Risk. There is no room for mistakes in the U.S. That's the main thing to take away. Where there is room is in the rest of the world. And so the dollar rolling over suggests to us that it is starting to think about, okay, where are there opportunities elsewhere? And if the policy mix gets better in Germany, Germany's done nothing for years. No one's invested there. If the policy mix improves in China and growth continues to pick up, no one's invested there. China is, quote unquote, uninvestable. But here's the fact, and this is a fact. This is not just discussion, a fact. FXI, the large cap China ETF, has massively outperformed the S&P over the last year. Massively outperformed, up 45% in the last year versus the S&P up 27%. KWEB, the China Tech ETF, has outperformed the NASDAQ over the last year. Nobody talks about it, but it's reality. And so whether or not there are tariffs put on China and Mexico, and here's the thing, this is why we say you don't really listen to President Trump. He's talked about tariffs all over the last couple of weeks. Mexico is up over the last month. China is up. The dollar is down. What does that tell? We like to pay attention to the markets, right? We want to follow not just the news, but the reaction to the news. As you pointed out, Emery, Trump is out there talking about asking people to, produce more oil. What is the Brent doing? Brent is up on the day. It's not worried about that. It's brushing that off completely.
Jay, there's so much to unpack there, but I just got to ask, is it ignoring wholesale completely, or is it ignoring but also have something in your back pocket if it's not just bark worse than bite, if there are actually big tariffs put in place? Or do you just discount that completely and say, I'm listening to the market, I'm looking at earnings, I'm looking at Europe being underpriced, and anything coming from the White House next 4 years, I don't need to pay attention to it all?
Well, earnings is key, right? That's very important. And earnings are going to be good. And our whole thesis is this global growth cycle provides the underpinning for the global equity bull market through the earnings channel. And now earnings and growth come from the spending in the competition amongst Europe, Asia, and Japan, and the Americas in AI, climate, and defense. So these things all feed together. They're huge. And therefore, that's what drives us. Now, again, if there's 60% tariffs on China, yes, China is going to be affected. But 2 points. One, anybody worried about tariffs in China is not invested in China, period. And that's why it doesn't react to the news. And secondly, 60% tariffs would destroy the U.S. economy. And so it's not going to happen. President Trump knows he was elected in large part because people really were upset about the inflation. Okay, so he knows, and his advisors know, Look, I'm a global macro guy. Scott Bessent is a global macro guy. When was the last time we had one of our own as a Treasury Secretary? I don't think it's ever happened before. So, I mean, that's great. But they understand there's very little room to maneuver in the U.S. 6% budget deficits, interest rates at 5%, the dollar at an all-time high. Our view is that U.S. assets have been the only place to be in the last 15 years. All the world's money is here. It's priced for exceptionalism. It's massively priced relative to the rest of the world. And therefore, we want to say, okay, you can have that. And we still have positions in the U.S., and don't get me wrong, we still have positions. But our focus for 2025, 2026 is that the U.S. led the way. Now the rest of the world is going to catch up. The rest of the world trades at 13 times forward earnings. The U.S. trades at 22 times forward earnings. Earnings outside the U.S. are expected to be as good or better than the U.S. in 2025 and 2026. Nothing is priced in terms of better economic activity, better policy making. They have the fiscal space. Germany and China, gross debt to GDP in the 60% range. The U.S., 120%.
It's this idea that Michael Purves talked about, that Trump making Europe great again. And we've heard it from other people, that the bar is low. I go back to the conversations at Davos. You heard from Christine Lagarde saying it wouldn't be pessimistic to say that Europe is facing an existential threat. You heard from Villeroy of the ECB saying that Trump should be a wake-up call for Europe to push structural reform. Casimir saying that Europe's competitive problem will get even bigger with Trump's economic policy. How much of this is, Jay, the bar is low versus you actually need to see Europe come together and put in some structural reforms? I know you're talking about Germany and the things that they can do, but how much of this does it need to be a Europe whole project to really make this region attractive?
Well, that's why we talk about the tripolar world of regional competition. It's not Germany, it's not the US, it's not China, it's regional, because no country has its own thing. And here again, the president, in talking about America first, is going against the tide in a massive way. And that's his brand, and that's what he does, and it's worked for him, obviously. But no country has what it needs to be successful in today's day and age. It's regional. It's who are your friends. And Europe has a very good position, but it hasn't like used its weight fully, right? It hasn't made that move to say, okay, we're fully European. We need to joint spend. We need to joint tax. They did a little bit with climate. They're going to do a little bit more with defense, but they're not embracing it fully. And so so they are nowhere really in climate, right? Their auto companies are getting destroyed. Germany's vaunted auto industry is in shambles, okay? They're nowhere in AI, nowhere. And they are thinking about spending more on defense. But here's the thing. Well, what happens if there is peace in Ukraine? Is that reconstruction bullish for Europe? Is that bullish for the euro? Is that bullish for rates? I mean, it seems like it would be. So to us, it's really the competition is sharpening. It's existential. Mm-hmm. It's AI. You have got to have it. It's climate. You have got to mitigate it. And it's defense. You've got to be able to defend yourselves. And that is the world we're in. And who has the fiscal space and the governance to do it well? China is in the lead, okay? We just look at AI, right? All the talk about AI in the U.S., China's just launched its large language model, DeepSeek, right? As good, according to independent experts, pretty much as good as anything the U.S. has, done at a fraction of the price, fraction of the price. And we have spent years trying to block China from the high level of the semiconductor space called Splinternet. And that's why we are in K-Web, because we think, yes, the U.S. is walling off its tech space from China. China is doing the same and walling off China from the U.S. Look at Apple. Perfect example.
Perfect. So we're going to talk about Apple in the next block. So
okay, well, real quick, Apple's market share in China is declining rapidly.
It is.
Okay, and therefore they are suffering and their stock is suffering. China is going to compete. Asia is competing. Asia is integrating. China now exports more to Southeast Asia than it does to the U.S. It's in a better shape than it was 4 or 5 years ago to deal with President Trump. And President Trump, I think, probably understands that. But for us, again, global growth cycle, we're in year 2 or 3. We think it can go another 2 or 3 years. Global equity bull market, we're in year 2. We think it can go another 2 or 3 years. The key is the U.S. has been the lead. Now the rest of the world is catching up. We want to play in that catch-up, that laggard opportunity space. We like emerging markets. We think emerging markets are going to do very well. We think China is going to lead there. No one's invested there. 12 times earnings. The opportunities, I think, are really significant. And as I said, commodities breaking out is a real key to us. It's telling us that the global economy is going to be fine. And when these non-U.S. stocks break out, everybody's going to be a food fight. And we're already there.
All right, Jay. You're sticking with us for the rest of the hour. Jay Pelosky of TPW Advisors. We want to get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Sonali Basak.
Thanks, Anne-Marie. Firefighters in Southern California are making progress battling new wildfires with much-needed rain now in the forecast. Up to an inch of rain is expected as early as Saturday, which may bring an end to the drought conditions that have worsened in recent months. Still, several blazes remain burning across the state, with the Hughes fire sitting at 36% contained. The Palisades and Eaton fires are 75 and 95% contained, respectively. And more trouble for Boeing. The plane maker suffered more losses and charges in the preliminary fourth quarter revenue report. In a surprise announcement, the aerospace giant said its sales missed expectations as last year's strikes impacted results. Boeing is set to deliver its full earnings on Tuesday. And over in sports, Novak Djokovic shocked fans at the Australian Open after retiring from the tournament in his semifinal match against Alexander Zverev. Djokovic dropped the first set and had to leave the match due to a muscle tear in his left leg. Zverev moves on to face defending champion Jannik Sinner in the men's final. And over in the women's tournament, American Madison Keys shocked her number 2 ranked opponent and moves on to the final, where she'll take on the world in number 1 Arina Sabalenka. That's your Bloomberg Brief, Anne-Marie.
Thanks so much, Sonali. Up next in the program, the morning calls, plus Mandeep Singh on Bloomberg Intelligence as we look ahead to big tech earnings. That's next. You're watching Bloomberg Surveillance. Good morning and welcome to Bloomberg Surveillance. Time for the morning calls. First up, Bernstein upgrading Netflix to outperform, citing its subscriber growth and rising operational leverage. Next up, we have TD Cowen raising its price target on Alaska Air to $110, seeing upside in its Hawaiian Airlines merger as synergies ramp up. And finally, Bank of America. They're getting in the news a lot lately, cutting its price target on Apple to $253, citing the weak macro environment and its staggered launch of Apple Intelligence. We want to stick with tech because investors will be bracing for big tech earnings next week. Meta, Microsoft, Tesla, and Apple all set to report. I agree with Jonathan on this. Bring the tech earnings up. You should have them the first week of the earnings period, especially NVIDIA, basically at the very end. That's very annoying.
The bankers would be so sad for you to say that, Anne-Marie. Do they get a downgrade then?
Yeah, I don't know. It's just this is a little bit more interesting. And I also agree with John. I like that they come after the bell because you can read through what you want and then have your ideas and thoughts prepared instead of this fire hose in the morning. All right, enough of that. Mandeep, how's it going? Tell us, what are you most focused on when it comes to the big tech earnings?
Well, so there are two pockets here. And when I look at the setup, TSMC results were very strong for AI. Netflix results, price increases going through, really propping the top line. So Google and Meta really should do well in light of that. Google, because of their cloud acceleration we saw last quarter. I mean, Microsoft's the same thing. Inferencing revenue of $10 billion this quarter should be strong again. And all the signs are the cloud segment is what's accelerating. On the ad side, I think the TikTok uncertainty should benefit the likes of Meta more, as well as YouTube Shorts. So that's where I think the setup looks really strong. I mean, Microsoft, I think with all the drama that's going on, with Project Stargate and them not being piece of it, still they are very disciplined on CapEx. They've told us they're not going to go big on the CapEx side. And if they show a revenue acceleration on the cloud side, I think that should be a strong quarter for Microsoft as well.
What happens with Apple, though, Mandeep? Yeah. There's just some extreme pessimism around this company over the past week and really so far over the past month, or even more than that, with shares down 11%. What is going on?
I mean, so there are a bunch of things, but I think the biggest factor is the tariff situation, because they are the company that is most exposed to China tariffs, whether it's 10% universal tariff or some other number. they get half of their COGS are related to China. So any sort of import on the tariffs will impact them. Clearly, not so much the likes of Google and Meta, although I would argue the tariffs will impact the data center build out as well. So there are all these dynamics. And look, Apple hasn't done much in terms of their own AI. They don't have their own large language model. So there are a lot of uncertainties on the software side when it comes to Apple, and that's what's playing on.
Mandeep, it's interesting what's going on in China. You talk about the tariffs, but Apple is losing market share rapidly in China to domestic producers as China starts to wall off its tech space from the U.S. companies, much as the U.S. has done to China.
That's not a news story, though. So I would say, the whole thing came about last year as well, where they were losing some share in a quarter. Then the stock really ripped higher. So when it comes to Apple, what people have realized, it's very hard to move out of their ecosystem. You can delay the upgrade, but you're not going to come out of the Apple ecosystem. And yes, they're not signing up more people in China, but their install base is so sticky that it's very hard to argue that, Apple is losing share anywhere. And I would say the same holds true for China. I mean, their numbers have been steady. They haven't been growing as much as the other regions, but to my mind, it's more to do with the tariff uncertainty and the Apple Intelligence launch.
Well, I was just in Washington. Tim Cook was at the inauguration. Is he asking for a carve-out?
Also, the whole tariff situation is so uncertain. Like yesterday, there was news that there won't be any tariffs on China. So it's hard to really kind of pin your assumptions down how it's going to impact their COGS. But look, we know that the companies that manufacture their goods in China, and Apple is not the only one. A GM or even Tesla, they're exposed to tariffs as well. And like I said, the companies that are building the data centers, even those are exposed to some level. But Apple is the most exposed.
Yesterday at the World Economic Forum, Trump blasted the European Union in terms of their regulation on tech firms. Do you think these tech giants will have a friend in the White House when it comes to at least EU regulation in Europe?
I think if Trump plays tough, which he is, with the regulators there, and he doesn't want the regulators to find these companies, it is a positive because that has been an ongoing problem, especially in the rollout of AI, because it involves using data for training. Meta has told the EU they won't even roll out their AI over there because they can't use the data. So clearly, I think it is a positive for big tech if he's acting tough.
Mandeep Singh of Bloomberg Intelligence, thank you so much for joining us. Danny, that's really Mark Zuckerberg's focus, isn't it? He mentioned this a lot on the Joe Rogan podcast as well.
Right, because you even see what they've done with their fact checkers. They got rid of them in the U.S., but notably, they've had to keep them in Europe, and that's because of regulation out of Europe. It is an uneven sort of application that they've had to have around the world. So perhaps what's happening is that by becoming closer with the Trump administration, they have a champion in the White House that can turn to Europe. And to Trump's point, speaking at Davos, answering Steve Schwartzman's question, that Europe has been unfriendly and he's going to threaten economic consequences unless things change.
John and Lisa said it a few times when they were in Davos. U.S. innovates, China replicates, Europe regulates. I think we'll see a lot more of that this year. Coming up next on the program, Kathy Bostjancic of Nationwide and Ashok Bhatia of Neuberger Berman. You're watching Bloomberg Surveillance this Friday morning. Good morning. TGIF, happy Friday. It's been a week, first full working week of a new president. Danny and I keep talking about the fact that we think he is kind of touching, or at least talking about, rhetoric is hitting basically every part of global financial markets. We saw that on display yesterday in Davos. Jay Pelosky doesn't quite agree with us, but we'll get more of that in a little bit. This morning, futures a little bit softer, but yesterday we did have U.S. stocks hit their first record high of 2025. We're now 1 hour away from the cash open. Here's your morning movers with Mr. Placebo, Manus Cranny.
Anne-Marie, a very good morning. We'll get to the placebo effect with Novo in just a moment. The numbers were so bad they pre-announced. Kelly Ortberg told the market, I've lost $5.46 The market was thinking I was going to lose $1.55. But it's interesting, we've only dropped 1 1/8. Again, this is a second quasi-kitchen sinking by Kelly Ortberg. This is a graveyard of one-offs on commercial airline, defense part of the business, $1.7 billion. The magic sauce is next week on the call. What are you going to do? How are you going to turn it around? By the way, the Transport Secretary nominee, Sean Duffy, has given a written statement. I'm not taking the cap off the MAX 737 production until those people who are qualified, well qualified in FAA, have given me the confidence to do so. And until you release the cap on the 737 MAX, this narrative is going to be hard to change. As I say, it's a graveyard of one-offs. Dreams go to die. Texas Instruments. When you produce for the industrial base, for vehicles, for huge industry, and you don't have the secret sauce for the AI chips that you can really squeeze the margin on, that's the story of Texas. What you've got here is going to be a bumpy road into the first quarter. You're going to earn between 94 cents and $1.16. That's way below the estimate of $1.17. But you've had 9 straight quarters of sales dropping on these big industrial chips, and therein lies perhaps a red flag to the overall momentum in the economy. 70% of their revenue is industrial and vehicle chips. You need the secret sauce. You need the NVIDIA high revenue chips to deliver. Novo Nordisk, when it comes to GLP-1s, they've got a new drug and it's doing really well. It's experimental. It's called emicretin. Take the high dose, you lose 22% weight in 36 weeks. If you take the placebo, of course, I was joking that I got the placebo, you gain 2% over the same period of time. But this is about, as Bloomberg Intelligence says, reinvigorating the head-to-head, I suppose, challenge with Eli Lilly and Zepbound. It is about building that moat in GLP-1s. Never mind the tech moat in chips. It's all about GLP-1s. Anne-Marie, good morning.
Manus, thank you so much. Manus Cranney for us. Looking ahead to next week, the Fed's first rate decision of the year is coming on Wednesday. Kathy Bostjancic of Nationwide writing, quote, unwavering consumer resilience reinforces the consensus that the Fed will hold off on policy changes in the near term. However, we still foresee the Fed resuming rate cuts in the second half of 2025, lowering the Fed funds rate by a total of 50 basis points this year. Kathy joins us now. Now, Kathy, I could be cute and say, is this because Donald Trump is telling the Fed to lower interest rates? Tell us what you see in the economy that you think the Fed is going to be able to resume those rate cuts.
Well, good morning, Anne-Marie. Happy to be with you. So we still see a very strong disinflationary impulse in prices, and particularly we've been encouraged that service inflation, which has been the stickiest, is actually showing some retreat in improvement, and particularly it's rental inflation. And given that it comprises such a large share of overall inflation, we think that, is really encouraging and does allow the Fed and gives them room to start to cut rates in the second half of the year. Now, there are some caveats around that. And one reason we think the Fed is going to wait out the first half of the year is because of some of the uncertainty as was spoken about on tariffs. Where we've actually seen inflation stall out over the last couple of months has actually been in the goods portion of inflation. Core goods are still falling, but at a slower rate. And of course, if tariffs are implemented and they're sizable, that's going to hit goods prices notably. So I think the Fed Reserve wants to wait and see. I think it's not just tariffs or changes in immigration, but also just the strength of the economy as we go through the first half of the year. But by the second half of the year, if we're correct, it gives them room to start to cut rates.
If they're waiting until the second half of the year, Kathy, I want to go where Anne-Marie hinted at. Donald Trump, who said that he would demand lower rates. What happens? What happens when you have a Fed that essentially, as soon as President Trump is inaugurated, they put the rate cycle on pause, the rate cutting cycle, rather?
Well, certainly we'll heat up the rhetoric and the pressure on the Federal Reserve. But, Chairman Powell has been really steadfast in trying to maintain the Fed's independence, and I expect that to continue. There's no opportunities really for new chairmen in the next 6 months, or even Fed governors, frankly. So I think that the Fed is going to be pretty immune to that pressure, which will be ratcheted up. But one thing I think that the administration has to keep in mind is if the Fed cut rates and let's say inflation was picking up or the economy was strong, you could get an adverse effect. What we've actually seen is long-term yields rise. And that's really what matters for corporations and for things like mortgage rates. So, I think you have to be careful what you wish for from the Federal Reserve.
Kathy, it's Jay. Do you worry at all about tariffs leading to inflationary pressures that force the Fed to hike rates rather than cut rates? Do you have any sense of the odds of Fed rate hikes over the course of 2025?
Yeah, this is a good question, and I know it's gaining some attention here. My sense, or at least our assumption, is that the tariffs will that are enacted will have a moderate impact on inflation, meaning that they're going to be strategically placed, and they're not going to be. Will have a price level change, but not necessarily inflationary, meaning it's not year after year. Prices are going up at a very high pace. To put that in perspective, if we had 25% tariffs levied against Canada, Mexico, which is not our baseline, and it may not come to fruition, even then you're getting 0.5% added to inflation. Now that's a lot, but it would push us a little bit above 3%. And I think the Fed would also look through that. Again, as long as it's not year after year increases, the Fed would say this is a price level. It's actually a tax on the consumer and the economy, but not necessarily inflationary. So they wouldn't raise rates because of that.
So perhaps we all need to take a page out of Jay's book and stop listening to the president to make our market trading decisions. Kathy, is the more important thing to listen then, and not just listen, but see the action and the consequences, is immigration? Because when you open up your Econ 101 textbook, you learn something that goes along the lines of wage price inflation is the one that you get that concern of an inflationary spiral. Is that the more concerning area then than tariffs?
I would say that, it's certainly the impact would be higher wages. If we have a dramatic change to immigration flows, yes. But if it is targeted to the undocumented workers, it tends to hurt sectors more than the overall economy. So it would really impact farming, agriculture, and construction. That's where the bulk of the undocumented workers are right now. But overall, I don't think it's going to have a huge pickup to wage growth. Even though we have a tight labor market, it's going to be really centralized. So not overly worried. Now, if we had a complete, stoppage of immigration inflow, which is very unlikely, then that would be a different story. But, that doesn't look to be the path we're headed towards.
Kathy, thank you so much for your time this morning. Kathy Bostjancic of Nationwide. Turning to fixed income now, Ashok Bhatia of Neuberger Berman making what he calls two bold calls. The first is that the new U.S. government delivers above-trend growth while containing inflation. The second is that the bond market consequently shifts focus from inflation and monetary policy to growth and fiscal policy. Ashok joins us now. Ashok, I'm just getting back from Washington, D.C., though, and you think they can contain inflation. But all this fiscal policy they're talking about, tax cuts, deregulation, this is going to be a lot of spending. Isn't it almost a vicious cycle?
Well, we are in a bit more of an optimistic camp. And I think, what we're going to get, obviously, is, immediately these discussions on tariffs and immigration. And then, as you noted, we're going to turn to the budget and the spending and tax cuts. And our sense is that what we will get is a package where the market concludes, this spring that the deficit is being stabilized. We're running about a 6% fiscal deficit. And our view is that as long as we have this package of policies where the market can conclude it's stabilizing, we don't need deficit reduction, we just need stabilization, that's going to be enough of a support for bond yields. Bond yields have started, obviously, and I think you spoke about it, pricing in term premium and some of these risks. So if we get, I think, even just a little incremental good news on this, the bond market will take it as a positive and as a shift in the expansion that we've all been seeing of fiscal spending.
There's been so much volatility, though, Ashok. Is there not a degree that even if what happens is accomplished, that because of the volatility, there just necessarily needs to be a higher term premium, especially on duration?
Yeah, I agree with that. I think, the end game of this is a steeper curve with term premium. And we've seen, term premium, move from deeply negative levels. This was when we had very flat inverted curves and central banks buying of government bonds and, even more, external central banks buying treasuries. So it's come back up, and I describe it as that we're at moderate sort of levels of term premium. Certainly, I think if we're wrong and all we get out of the budget is tax cuts and more spending, there is scope for it to go higher. But on volatility, there is, and I think our central case is that, and it's similar to what Kathy was saying, that this is going to be a year of relaxation of inflation. It's going to be a year where the Fed can, reduce interest rates twice, maybe once, maybe twice. We're priced for a reasonable terminal rate. So if you get that from the Fed plus a little bit of deficit stabilization, that's a pretty strong outcome for the bond market. And I would think we'll see a little less volatility compared to what we've been seeing the last couple of years with term premium and the central banks in motion.
Ashok, it's Jay. Which do you expect to see first, a 10-year over 5% or below 4.4%?
Below 4.4%. I think it is more likely, and we think it's more likely at this point that you'll see some evidence of we saw the CPI print last month, and I think what Kathy, coming back to what Kathy said, I think it's some important comments there about what's going on with services inflation. We would add in what's going on with shelter inflation as well, also going to push inflation down. But, we think it's more likely the next few months bring, a little bit more stability in the jobs market coupled with lower inflation numbers. And, given where we are, that's probably worth, getting 25 basis points more in lower 10-year yields.
So to press you just a bit, so 4.4 is in the picture. Where do you see it going to? Is it 4.25? Do you see 4%? I mean, curious as to how far you think this can really go.
I think, our view is that the terminal rate, and this could be this year, it could be next year, the timing of this is tricky, but, ultimately we think the Fed's going to get down to about 3.5%. And if the policy rate, the Fed funds rate ends at 3.5%, that kind of, says the 10-year rate should be maybe 4.25. So I think that's a good kind of intermediate term fair value. And, recognizing that bond markets often overshoot on one way or the other, maybe you do see it down to 4%. But this is still, rates are positive. They're going to stay positive. And I think broadly speaking, this 4 to 5% zone is we're going to spend a lot of time over the coming years in this range.
Ashok, I also feel like what you're saying is perhaps music to people who have to put together a cross-asset portfolio. Is it your estimation that we're going to have a bond market that is calm, that is finally something of a haven, that you can finally prop up against risk assets for the thing that protects your portfolio? Are we getting back to some sense of normalcy?
That is our view. I think, we see, I think you're going to have a limit just given, the amount of rates that they could potentially decline. There's going to be a limit to these diversification benefits. But certainly, coming back to 2022 and the hiking years, fixed income can have hedge properties against risk assets again. And so I definitely agree with that. And I think just picking up on one thing you said, too, on multi-asset portfolios, one thing I think, we're paying a lot of attention to is the dollar, obviously, coming off very strong levels. We're starting to see this year, and it's partly, maybe a little bit better message on tariffs, but some of the strength in emerging market currencies, a little bit, movement of the dollar weaker against the euro. These are pretty tentative moves. But in addition to rate stability, if you can get, at minimum, the dollar stop appreciating and maybe even get a little bit of contained weakness, that's something else that also introduces some new dimensions to these multi-asset portfolios, too.
Ashok, thank you so much for your time this morning. Ashok Bhatia of Neuberger Berman. Up next, we're going to set you up for the week ahead with the Fed decision around the corner and Donald Trump hitting the road. You're watching Bloomberg Surveillance. Good morning. In TGIF, we're going to count you down to the opening bell. Here's the trading diary for the week ahead. At 10 a.m. Eastern, we'll get you UMich sentiment. Tuesday, durable goods. Wednesday, of course, a Fed rate decision followed by a chair Powell press conference. We obviously know already, you can write those questions and what they're going to be. Probably what the president said yesterday, that he knows interest rates and rate policy better than him. Didn't name him, but we know who him is. Plus tech earnings from Microsoft, Meta, and Tesla. And Thursday, Apple and Intel report. Of course, ahead of next week, President Trump traveling to hurricane and fire-damaged areas of the United States today. His visits to North Carolina and Los Angeles mark the first trip of his second term. Joining us now is Libby Cantrill of Pimco. So he's making a ton of news. It's the first full week, basically, working week of his administration. Slew of executive orders, jawboning the Fed, telling the Saudis to add more barrels to the market, and then last night seemingly signaling to China that he has the power to tariff them, but he doesn't want to use them yet. What do you take away from all of this?
Yeah, I mean, it has been flooding the zone. You forgot about the big AI announcement as well. I mean, that in itself would have been a massive announcement that would have driven news for a week, and yet it was a little bit drowned out because of all these executive orders. I mean, obviously, a lot of our clients very focused on tariff risk. I think, taking some comfort in the fact that President Trump hasn't done anything at least definitive on China or other countries. I mean, we think it's a little premature to start celebrating, and we think the direction of travel here is very clear. They did issue an America First trade memorandum that was basically a roadmap for how they are thinking about trade. It goes from everything from kind of rewriting free trade agreements to looking at currency relationships to looking at outbound investment from the U.S. to China. So I think what we are telling our clients, and then also I'm telling our traders, is let's not sort of celebrate this too prematurely. This is a deep-seated ideology, as we've talked about. There's a revenue component here, but there's also, I think, he believes in tariffs. He believes in tariffs work in terms of reducing the trade deficit. As it relates to China, I mean, it is complicated, right? There are other things that I think the president wants from China. As it relates to the Ukraine war, for instance. And I think that he is intentionally sort of slow walking tariffs or actions on China. We should not conflate that, though, with no future action, because I do believe that tariffs will be increasing probably across the board, but also on China in particular.
Well, when it comes to the signal he's sending, maybe he's slow walking it, that's been a huge relief rally, even just today in Asia, in Europe, in global currencies. The dollar's much weaker. But when it comes to China, it's not just the war in Ukraine, it's also TikTok. There's so many levers he's trying to pull. Where does all of this stack up in terms of the priority list?
Yeah, well, I think that's an open question. And I do think, I mean, these are our different dimensions. I think different advisors care about different things here. Of course, as we've talked about, he has a cadre of folks who are advising him under Trump 2.0, who are also there under Trump 1.0, who don't necessarily trust the Chinese. They view that the Chinese do not honor the Phase 1 trade agreement. I think there's going to be a real review. I mean, in this memorandum, there's an order to actually look at the Phase 1 trade agreement, to kind of create a scorecard around that and to publish that. So I do think, again, this is, actions are likely coming on China. I do think the market, though, should celebrate the fact that it's going to be intentional. It's going to be thought out. It's going to be strategic, and maybe not sort of the worst fear that the market at least was predicting.
Can I just go back to where we started, this very simple fact that we got so much this week? I mean, it is a reminder of what it was like around last time, that you have him talking to reporters, making news, posting things on social media, making news, giving different speeches. It is a lot. What is your advice to your traders, to your clients, and how to sort through all of it, and what to pay attention to, and maybe what you can ignore?
Yeah, I mean, great question. I think, from a fixed income perspective, right? What drives bond yields, growth, inflation, currency, and of course, obviously the Fed at the end of the day in terms of the U.S. So anything that really will have a tangible impact on those drivers. A lot of these executive orders, I call them kind of more sizzle than steak. A lot of them are, for the sort of shock and awe value versus actually the substance value. Now, a lot of them will be more substantive. And I think even on the federal workforce, some of the things he's done in terms of the hiring freeze, rolling back the DEI, while that may have a long tail, that will have an impact in terms of, employment of federal workforce and potentially incrementally on the budget. At the end of the day, though, the big things that drive the markets are going to be, again, the big macro movers. A lot of that has to do with Congress. And we haven't, Congress, as Anne-Marie and I lament, Congress is understandly trying to get their ducks in a row with navigating incredibly narrow majorities. And so, I think the focus will probably turn away sort of inevitably from him a bit. and onto Congress once they start proceeding with this reconciliation bill and taxes and spending cuts and what have you.
Yeah, Libby, Jay here. I'm curious as to how important the foreign investor base is for treasuries. We have a tremendous amount of treasury issuance coming this year, dollar starting to weaken, foreign investors very heavily invested in U.S. assets. Is there any concern at all that perhaps this can build on itself and foreign investors become less interested in treasuries and pushing the yields up and price down?
Yeah, I mean, I think that this has been a concern in the marketplace over the last few years around sort of de-dollarization, around foreign central banks sort of diversifying away from kind of dollar-based assets into a basket of other currencies and other sovereign assets. I'm not sure we've really seen a lot of data that actually supports that. In fact, when you did see sort of some foreign buyers kind of pull away over the last few years, you actually saw some domestic pension plans and institutional investors actually sort of filled that gap. But recently, it looks like, according to the data, that there has been more activity in terms of foreign central banks. And that's partly just because yields look pretty nice, right? I mean, it is the U.S. bond market actually, looks pretty attractive right now from both a nominal yield, but also a real yield perspective. And if you think that maybe he's going to do something on tariffs, but it won't be the sort of the full kind of Monty on tariffs, then maybe you're sort of starting to dip your toe into the water. So I don't think we see that as a real concern. And again, there seems to be a lot of domestic demand that has supplemented that.
Does he wait for tariffs because he wants the good news that can happen with a reconciliation, what he calls one big, beautiful, powerful bill to come out? Is that what he's waiting on? Bake in the good news first to the financial markets and then potentially add in some of the not so great stuff?
Yeah, I mean, I do think there is going to be a consideration around sort of eating your vegetables and eating dessert. And I think trying to give both to the market. So they're not just trying to chew on one and not chew on the other. Obviously, as we all know, folks in this administration are very markets oriented. President Trump views the economy under Trump 1.0, the S&P under Trump 1.0 as part of his legacy. So I do think they're going to be mindful of all of this. Again, though, I wouldn't confuse this with the fact that we're not going to see tariff action.
Right.
And I do think maybe something that in the marketplace that's maybe not being taken as seriously is sort of the threat on Canada and Mexico. As we know, the USMCA review is coming up next year. It sounds like President Trump might want it to actually pull that forward, and the tariff threat might be sort of associated with that.
The review started. He's negotiating, Libby.
The review is
it's on.
Sorry. And who will be negotiating that on behalf of Canada? Sort of TBD,
yes.
Obviously. But I do think that is sort of part and parcel of this. So while I think investors and we have been sort of focused on the potential China actions, they actually might be much closer to the United States, our neighbors up north.
Libby Cantrill of Pimco, thank you so much. And Jay Pelosky of TPW Advisors, thank you for joining us for this hour. Coming up on Monday, John and Lisa will be back with me. Seema Shah of Principal Asset Management, Victoria Fernandez of Crossmark, Neil Dutta of Renmac, and Oksana Aronoff of JP Morgan. This was Bloomberg Surveillance. Thanks for joining us. Happy